Good morning.
Good morning.
I'm here, smile on my face, raring to go.
Good morning. Phone number ending in 482. Could you please identify yourself for the record and for which item on the agenda you're here for?
Daniel Touch Totos Inc.
963
963 68 13 3045.
What is your business name?
Totos Inc.
Okay, it's right here. Thank you very much.
Hi, Alan Smith, you have your hand raised? Are you able to see and hear us okay?
I can hear you fine. I would just want to be able to mute my line when I'm not talking so I don't interfere with your meeting, with the meeting. I wanted to make sure I was muted.
Yeah, you were.
Okay, I'm going to go back to mute.
Okay, no problem. Thank you so much.
Call in user 1. Oh, do you see that one?
I'm just gonna have to ask a couple of these people, like Louise.
Lewis, that's Lewis, probably Lewis Soka. Let's double check. Oh,
Okay. Louis, I've asked you to unmute yourself. Could you please confirm that it just says your first name on there?
It is Louis Zoka. Yes, it is Louis Zoka. Sorry about that.
No problem.
thank you.
And then I'm assuming I'm going to be muted and my camera turned off until it's my turn to chime in for the meeting, right?
Correct.
Okay, perfect. Thank you so much.
Thank you.
Good morning. Can you hear me okay?
Hello, Chairman DeVold.
Thank you.
We don't get all.
If you're calling in on the phone and we haven't yet identified you, could you please unmute yourself and let us know your name and what agenda item you're here for?
Yeah, I'm calling for. I'm calling for Hector Camacho. I guess ID number 96368133045.
Okay, and what's your business name?
Hector Camacho.
Hector, okay.
Hector Camacho.
Nice. Thank you.
Thank you.
Hello?
All right, go ahead.
Yeah, can you hear me now?
Yes.
Okay, I'm calling, it says, you want the TID number or the name?
The name, please.
4 Bento LLC, the number 4 Bento.
Thank you so much.
Thank you.
Hi, this is Tina Poff with the Clark County Assessor's Office. And I'm calling for the Globe Salon LLC penalty waiver under 4B.
Yes, thank you very much, Tina.
You're welcome.
Okay, and we also have somebody that's named call-in user 1. I've asked you to unmute yourself and phone number ending in 000.
Hi, this is Crystal Carrasco with St. Mary's Medical Center.
Thank you.
Thank you.
And person who has initials BTO, if you could please identify your name for the record, please.
Yeah, it's Commissioner Rigby. Just to let you know, my internet has been up and down all weekend, and hopefully it will stay on today. But if not, I'll dial in the best I can with the phone.
Thank you.
And phone number ending in 465, if you could please unmute yourself and let us know your name and which agenda item you're here for. And the member for BTO, looks like you're unmuted with your hand raised.
Hi, did you say something to me, for Bento?
BTO.
No, it's BTO.
Oh, okay. Thank you.
Thank you very much, though.
No problem.
So there's a couple.
Okay, and phone number ending in 465, if you could please identify yourself.
Hello, can you hear us? This is phone number ending in 4465.
Yes, we can hear you. Could you please identify yourself for the record?
Thank you so much. Yes, we have Chuck Spicer and Brian Barrett, and we are part of Nevada Organic Remedies LLC, Section C, item number 8 on there.
Great, thank you so much.
Thank you.
Phone number ending in 050, if you could please unmute yourself and identify yourself for the record. We also have a couple other phone numbers that have called in, numbers ending in 070, 050, 010, 484, 585, 000, 101, and 984. If you guys could please identify yourselves for the record.
Hi, this is Bryce Olson calling in with BTO Investments.
Thank you so much.
Came disconnected again.
And a call-in user number 3, could you please identify yourself for the record?
Good morning. This is Deputy Attorney General Peter Keegan. Phone number ending in 1153. I've joined the call.
Thank you so much.
Thank you.
Christina, this is Cheryl in LGS. I'm dialed in too, so I'm here.
Okay, thanks so much, Cheryl. Are you calling from the office or from your cell phone?
From the office.
Okay.
Thank you.
Gotcha. Okay, thank you so much.
Welcome.
Hello,
this is phone number ending in 484.
Hello. Go ahead with your name, please.
My name is Leonard Smith, and I'm the attorney for Expertise Cosmetology Institute, which is page 2, section E.
Great, thank you so much.
Thank you.
Hi, this is Suzanne Warren. I'm here for Gamblers Trading Company, Inc.
Thank you. Thank you so much.
This is Kyle Waugh with L Makeup Institute, phone number ending in 298.
Thank you so much. Phone number ending in 377, if you could go ahead and please identify yourself.
Yes, my name is Tom Natale, just representing myself.
Great, thank you so much, Mr. Natale.
Thank you.
Okay, and phone number ending in 122, if you could please identify yourself for the record.
This is George
Yes,
Co Assessor. Hello.
Hi, Commissioner Classes, thank you.
Okay, thank you.
Yes, this is Dawn Scott, number 122, representing Nextel System.
Thank you so much, Dawn.
Did I lose you guys?
We can hear you.
Tax guest disconnected.
Good morning, Commissioner Classes.
Is that you, Jim?
Yes.
Randy?
Morning, how are you?
Good, how are you?
Good, you're coming in loud and clear.
Okay, good, thank you.
So we'll get started in about 2 minutes.
And you said you can hear me? This is Heather Campa.
Hear you perfectly.
Hi, Heather. Yes, we can hear you.
Oh, perfect. Okay, thank you.
You're welcome. Okay, and we've had a couple additional phone numbers who have called in. I've asked you to unmute yourself, so if you could please identify yourself for the record.
Good morning. My name is Corinne Adams. I'm calling on behalf of Larry and Teresa Cantwell.
Thank you so much.
Thank you.
This is Commissioner Bursey, just checking if you can hear me.
Hi, yes, we can hear you so much, Commissioner Bursey.
This is 050 John Barbarotta. Can you hear me?
Yes, we can hear you. Chairman DeVold, will you give us just 1 or 2 minutes? We need to run over to our IT department. Our Wi-Fi seems to be going in and out. Just give me just 1 moment.
Yeah, perfect timing. It's 9 o'clock.
Can you guys hear me as well? My name is Lori Baxter.
Yes, Lori, we can hear you perfectly.
Thank you so much.
You're welcome. So will you let us know when you're ready to begin the meeting? Is Tina in the room, or is she working on something with the IT department still? You're
Good
on
morning,
mute.
Jim.
You're on mute. Sorry.
Oh, sorry. Thank you. She'll be in here with me the whole time. She just ran over to IT, but she just came back in, so.
Okay, are we ready to begin the meeting then?
Yes.
Okay.
Hey, Jim, this is, good morning, Jim. This is Tony, just for your, begin, I can't hear you. You're breaking up, so. I don't know if everybody else can or not.
Yeah, I can hear you perfectly. So.
I can't hear you.
Mr. Chairman, it's very difficult to hear you.
How about now?
Still not good.
Can you hear me? Tony?
Yeah, just barely. It's a little bit better. You're still breaking up a little bit.
Tony, can you hear me now?
Yes, sir. That is better. Thank you.
Okay. All right, let's go ahead and get started. I'm going to call the meeting to order of the Nevada Tax Commission for October 5th, 2020. Tina, would you call roll, please?
Whoops.
Tina, you're on mute.
All right, I'll do roll call. Commissioner Littman.
Present.
Commissioner Bursey.
Present.
Commissioner Brown.
Present.
Commissioner Colessis.
Present.
Commissioner Wren.
Present.
Commissioner Rigby.
Present.
Commissioner Witt,
Present.
Chairman DeVold.
I'm present as well. Okay, let's go ahead and start with public comment. I want to sincerely thank everyone for their patience as we continue to have meetings remotely and via Zoom. I know this is not the best, and I appreciate everyone's patience. If you have public comment, please raise your hand by dialing *9, and the department staff will unmute you. Go ahead, staff, and we will invite public comment at this time. Is there any public comment at this time?
It doesn't look like we have any hands raised.
Okay, thank you. Okay, Executive Director Young, could you please administer the oath?
Good morning. Melanie Young, Executive Director for the Department of Taxation. The oath will be by testifying in this meeting today. You are attesting that you will swear to tell the truth in the proceedings here today. Thank you.
Okay, very good. Next item on the agenda is the meeting minutes. I'd like to entertain a motion for approval of the August 17th and August 27th Tax Commission meeting minutes. Is there any additions or corrections to those minutes?
Commissioner Brown, motion to approve.
Commissioner Witt, second.
Got a motion and second. All those in favor, please signify by saying aye.
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 Anyone opposed? Okay, minutes are approved. Item number 3, the consent calendar. Are there any items that anyone would like to pull from the consent calendar for further discussion?
This is, Mr. Chairman, this is Commissioner Wren. I would like to pull a couple items off the consent agenda, but it's the second section in F. If you're calling that one also, or do you want to do the first one first?
No, go ahead and tell me which ones that you'd like to pull, and then we'll approve the consent calendar.
I'd like to pull F, number 6, and number 11, please.
Mr. Chairman?
Yes.
I would like to pull item D4, Nextel Systems.
Any other items?
Yes, Mr. Chair, I'd like to pull, this is Commissioner Bursey, I'd like to pull item 3B3.
I'm sorry, I missed that. Is that Sierra Repair? I'm sorry, you're on mute.
Yes.
Sierra Repair. Any other items? Okay, could I entertain a motion to approve the consent calendar with the exception of items 3, 4, and F6 and F11?
Mr. Chair, this is George Palacis. I would move to approve.
Second.
Okay, got a motion by Commissioner Klessis, seconded by Commissioner Brown. All those in favor, please signify by saying aye.
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 Anyone opposed? A consent calendar is approved. Let's go back to item B3, Sierra Repair. Commissioner Bursey.
Yes, this is just a quick clarification question for just to have a proper record. It appears on page 19 of our materials, and I believe that the department in the memorandum to us has recommended in the first place to waive the penalty in full, and in the second place, the recommendation is to, if approved, the total amount equals the interest and the penalty. So I'm just wondering which it is we're approving.
Okay, I believe Bill Steves, Mr. Steves, are you on the line?
Yes, good morning, Mr. Chairman.
Good morning.
Yeah, I'm going to defer this to my Reno staff if they can speak to that, please.
Thank you.
This is Jennifer Lewis for the record, audit supervisor. We are requesting for penalty, waiver of penalty and interest on this taxpayer.
Thank you, that helps a lot.
Commissioner Bursey, could you make a motion to approve that item if you're satisfied?
Yes, Mr. Chair, I would move to approve Sierra Repair Inc.'s request for waiver of penalty.
Commissioner Wren, second.
Okay, and just to be clear, it's penalty and interest. Is that what we're voting on, correct?
I'm sorry, penalty and interest.
Okay, all right. I've got a motion and second to approve the penalty and interest on Sierra Repair Incorporated. All those in favor?
Aye.
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 Anyone opposed? Okay, the next item from the consent calendar was item D4, Commissioner Rigby.
Yes, on the consent calendar document, page 76, where we have Nextel Systems, the first paragraph says that they're recommending approval of a refund request in the amount of $1,098,381. And then down in towards the bottom of that page, it says they're requesting, is it $992,083? Yeah, $992,083 on the top of the next page is what you're recommending for the refund. I just wanted to clarify that the actual settled amount was $992,083.
Mr. Steves, I believe that one's on yours as well.
Yes, it is, sir. Good morning, Bill Steves for the record. Yes, Commissioner Rigby, you are correct. It's the 992 figure. That was their original request. Through the audit process, we reduced that credit amount to the 992 figure.
Okay. I'm just confused about the way it's worded on this sheet, but I'm happy with the result, but this isn't the way it would normally appear, right?
Mike, could have been worded better.
All right, then I would move to approve item 3D for Nextel System Corp. Refund.
Okay, Commissioner Littman, I think you're on mute still. I still can't hear you. Well, I can't.
Second for Nextel, approving and seconding the motion.
Okay, thank you, Commissioner Littman. All those in favor, please signify by saying aye.
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 Anyone opposed? Okay, very good. Let's see, Commissioner Wren, the next two items, F6 is Alan Lujan.
Thank you, Mr. Chairman. I basically have the same question on both of them, and my question is probably for either Lizette or Adrian. I run into this in other cases on the consent agenda and really want to get an understanding on how you work with these compromises in cases like this. And number 6, the compromises for $12,000, $200 monthly, and this individual has a $615 car payment. And I'm just wondering why there isn't less car payment and more tax payment.
Presented to you. You can approve it or not.
Good morning, Mr. Chairman and members of the commission. This is Adrian Roberts Larson for the record. Good question. we're looking at this as the monthly payment on the vehicle is set. It's not something that he can change at this time. And that taken into consideration with the living expenses and with the other documents presented to you, we felt that this was a reasonable offer at this time. Certainly the individual is fully liened. So we could, as a department, continue to pursue collection should the commission not agree with the recommendation to approve. But we leave that to you.
Okay, and thank you. And I kind of understand that. It bothers me when we've got an offer in compromise of $200 a month when to pay off $12,000 when they could have a car payment of $400 a month and pay taxes of $400 a month and pay off $24,000, which would come off closer to paying the taxes itself. And then kind of the same question on number 11. I'm sure it's kind of the same answer, but they've got 2 car payments, the total of $547, and the second car payment they took out looks like it was right around the same time as you were making offer in compromise, and they bought it in car. So how's that work?
And certainly the difference with the second one is that on this levy, the department does not have the debt fully liened or secured. So certainly we will, again, look at all the expenses, the income, we'll look at the car payments. As referencing in the first one, we'll look at the payday loans, things like that. But the offer as it stands for Ms. Levy, we're accepting because we cannot pursue the debt any further.
Okay. All right. And of course, I really appreciate all of your hard work on this. Like I said, I struggle when I see these numbers, and they, we can't control how people live, but the way they live is how they got into this problem to start off with. So having said that, Mr. Chairman, thank you. I would move to approve the offer of compromise for number 11, or for number F, number 6, and 11.
Thank you, Commissioner Wren. Is there a motion to a second to the motion?
Second by
Mr. Witt.
Colossus.
Oh.
I've got a motion by Commissioner Wren, second by Commissioner Colossus. All those in favor?
Aye.
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 Anyone opposed? Okay, that's the balance of the consent agenda. So if anyone is on the telephone that wishes to read out your items have been approved in the consent calendar number 3. Items A through F have been approved. You're welcome to leave the meeting now or stay on as you choose. Okay, the next item, Executive Director Young.
Good morning, Melanie Young, Executive Director for the Department of Taxation. For the record, moving on to agenda item number 4 for the Division of Local Governments. Item A under that agenda item is the consideration of the addendum to previously adopted 2021-2022 Bulletin 210 Assessment Instructions for Agricultural Land to include tables relating to the valuation of open space golf course land and improvements. The department has Cheryl Erskine on the call. Thank you.
Good morning, Mr. Chairman and members of the Commission. For the record, I'm Cheryl Erskine, Coordinator of Assessment Standards for Local Government Services. This morning, I would like to present for your review and approval the 2021-2022 Golf Course Table Addendum to Agricultural Bulletin number 210, which was approved by this Commission on May 4th, 2020. This addendum is prepared in accordance with NRS 361A.225 and is being presented now due to the Consumer Price Index tables published by the Bureau of Labor Management not being updated until after July of this year. This prevents LGS from updating golf course land values in time for the May Tax Commission hearing for consideration and approval with the Agricultural Bulletin. As you can see in the first table, the land values of golf courses is calculated by considering the July 2020 CPI amount of 275.597, which results in a factor of 1.43. When this factor is applied to the 2004 taxable per acre value, you get this year's taxable per acre value of $4,090. This proposed value increase results in a 1.41% change over last year. The second table shows this year's Marshall and Swift factors, which are used in valuation of golf course improvements throughout Nevada counties. The third table lists golf course rating points assigned for par ratings to be used to determine whether a course is a class 1, 2, 3, or 4 pursuant to NAC 361A.4410. The tables on page 2 list per hole costs and individual components that could be located at a golf course, such as storm drains, bridges, and water features. At this time, I would like to request approval of the golf course addendum to Agricultural Bulletin number 210 for 2021-2022. I'd be happy to answer any questions you may have.
This is Commissioner Witt. I move to approve the Agricultural Addendum 2021-2022 Bulletin 210.
Second.
Okay, I've got a motion and second. Is there any other discussion?
The only comment Commissioner Witt would like to make is we just need to remember that golf courses are really grass farmers.
Very good, thank you. Anyway, yeah, forget it. All those in favor, please signify by saying aye.
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 Anyone opposed? Okay, very good. Motion's approved. Executive Director Young, next item.
Thank you. And Melanie Young, for the record. The next item on this agenda is the item B, taxpayers' appeal of the treasurer's denial of waiver of penalty and interest per NRS 361.4835, which is from Clark County. And that agenda item is Globe Saloon LLC. And the department has Jeff Mitchell available for questions. Thank you.
Okay, is there someone available for comment on the Globe Saloon?
Good morning, Mr. Chairman. This is Jeff Mitchell with the department. I'm not sure if a representative from Globe Saloon LLC is available. I know that somebody from Clark County is available, but both were properly noticed.
I believe that Katie Kanata was on the line for Globe Salon. If you're still there, please dial *9 to raise your hand. I don't see her on the line now, but I think when we did roll, she was there.
And I believe somebody from the Clark County Tax Assessor's office is on the line as well.
Yes, this is Tina Poff with the Clark County Assessor's office.
Okay. One more time, anyone from the Globe Salon LLC on the phone?
If you're on the telephone, please dial *9 to raise your hand.
Hello, I apologize. Hello, I apologize. May I interrupt for 1 second?
Yes. Are you with the Globe?
I'm not sure. No, I'm not sure if they called me or not yet. May I ask if my hearing was discussed? I heard you guys say that a bunch of them were approved A through something. I just didn't know if I missed it.
What's the name? I'm sorry.
I'm sorry. Yes, it's the number 4 Bento LLC. I didn't know if you got to that yet.
That was approved in the consent calendar under 3A1A.
Yes.
It was approved?
Your item's approved. Thank you.
Okay, I appreciate that. Thank you very much.
You're welcome. So one last try. Anyone from the Globe Salon LLC on the phone? Okay, very good. Mr. Mitchell, do you want to go ahead and present this? We'll. It's an appeal, so I'm not really sure what else we can do if the taxpayer's not here to make their case.
Correct. Jeff Mitchell for the record. contained in your packet is the information that was submitted from Globe Salon LLC and the replies from the Clark County Assessor's Office. I guess if there's any questions on the documentation, I can't really speak to in detail on what was submitted. But if there's questions from the Clark County Assessor, I know that they are available.
Okay, very good. Is there any questions from any of the commissioners of the Clark County Assessor or staff?
Commissioner Lippman.
Yes.
Commissioner
Lippman.
Rigby?
I'm sorry, Commissioner Lippman, go ahead, please.
Yes, I'm curious. So what has happened is this is a salon that had to shut down because of the governor's mandate on COVID-19. And as a result, not surprisingly, they had cash flow issues. So they were late in paying their property taxes. And they're asking for an abatement of the penalty. And as we all know, the penalties are significant because we need people to pay their property taxes in a timely manner. Is there any recourse other than our approval for this issue? I know that the department, we can see in all the documentation we've seen, has had significant COVID-19 abatements of interest and penalties. So how does it apply to these taxes, property taxes?
This is Tina Poff with the Clark County Assessor's Office, Commissioner Lippman. Can I answer how we've been handling that?
Yes, and that I was asking you. So thank you very much.
Oh, okay. I wasn't sure. So basically, the statute provides us, NRS 361-483-5, provides us the opportunity to waive any penalties and interests that are considered outside of the control of the taxpayer. So we have used that to apply it to the COVID-19 situation. And the way that we have done that in this particular situation, the taxes were due February 22nd, and the penalty was assessed March 3rd, which was before any of the shutdowns, which is why we denied this particular case. But any that were due between the shutdown till the end of May when things were really starting to open up, if they tell us it's a result of the COVID and they've paid or they've set up a payment arrangement, we have waived all of those penalties. If there's situations outside of that, then we're looking at those on a case-by-case basis. But pretty much anybody, the taxes were due between March 18th and June 1st, we're automatically considering that. A pandemic is outside of any of our control. So, and this was not approved because their taxes were due and the penalties were applied prior to any of the shutdowns.
That's very helpful. I am a little bit concerned that the taxpayer isn't here to perhaps present their case. Should we pull this? Because perhaps the taxpayer is having technical difficulties getting on. I know that you saw them, Tina, earlier. What you're saying would count. The county's position sounds very reasonable, and I appreciate what you're doing. I can only imagine the tsunami of work you're facing. And what you're saying makes sense that this was before the shutdown. But perhaps the taxpayer hasn't presented information that they should have to make their compelling case.
Commissioner Lippman, this is Commissioner Wren. Could I make a recommendation, please?
Please.
You know, I'm looking at our agenda. We've already just wiped out $350,000 because of COVID. I'm telling you that at the end of February, beginning of March, a lot of us realized this pandemic was going to be serious. I would recommend, I'm going to make a motion to waive the penalty and interest of $125.09.
This is Commissioner Colestis, I'd second it.
Thank you. And discussion, obviously, as you can see from my video here, I have not gone to my cosmetologist since early January. And so I appreciate that this Globe Salon and not Saloon shut down in a timely manner. So I appreciate the commissioners joining me and I guess we're actually approving the taxpayer's appeal of the denial of the waiver of penalty and interest. So we are waiving the penalty and interest. Thank you.
Okay, so I've got a motion by Commissioner Wren and seconded by Commissioner Palacios. Is there any other discussion? All those in favor, please signify by saying aye.
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 Is there anyone opposed?
Yes, I am. Commissioner Bursey.
Commissioner Bursey is opposed.
And Commissioner Brown is opposed as well.
Commissioner Brown is opposed. Okay, motion passes. Thank you for your time. And to the Clark County Assessor, I really appreciate your time and how you're handling this. I think you're doing it absolutely perfectly. So thank you very much for your time. Hey,
thank you so much.
You're welcome. Executive Director Young, next item.
Melanie Young, I'm Director for the Department of Taxation. For the record, the next agenda item is the determination and allocation of certification of centrally assessed 2021, 2022 secured and 2020, 2021 unsecured unitary property valuations and assessment pursuant to NRS 361.320 and NRS 361.321 and NRS 361.323. And the department has staff available for questions. Thank you.
Good morning, Mr. Chairman and members of the commission. This is Jeff Mitchell. I'm the Deputy Director over Local Government Service. Today with me is Wren, who is the Supervisor of Central Assessment. And we have presented the 2021-2022 secured roll and the 2020-2021 unsecured roll for Central Assessment. These valuations are brought forward to you based on NRS 361-320 sub 2, where the tax commission is to establish the values for the respective rolls. Taxpayers provide us information, and based on formulas contained in regulations, valuations are established within guidelines, and the apportionment of the value is established. After the work papers were submitted for your approval, it was brought to our attention a couple of details that I'd like to bring to your attention. On each valuation page, at the bottom of the page, we attach for analysis purposes prior year assessed valuations. These values are already historically set, and they're only there to provide comparison from prior years to this year. Based on a variety of reasons, the methodology and information contained in the analysis portion of the worksheets is not consistent from company to company. Plus, there are a couple of minor typos contained in those analysis. This makes using the information in the analysis portion for the tax commission for comparison purposes extremely difficult, and we apologize for those oversights. We have resolved that the formatting and consistency and methodology on the analysis portions will be changed in forthcoming years and will be a better tool for the tax commission to use. With that being said, we are confident in the assessed values that are being presented for approval and that are on the valuation worksheets, and can speak to any questions that the commission may have in regards to the valuations. Mr. Soren Popa is here to answer any questions that you may have on the valuations, but that at this time we ask for your consideration and approval of the 2021-22 secured and the 2020-2021 unsecured centrally assessed rolls.
Any questions from any of the commissioners?
Mr. Chairman, this is Commissioner Rigby. I would like to ask a couple of questions just to help with my understanding. If you were to go, for an example, to Charter Fiber Link, which is page 93 of our document, there's a book cost less depreciation figure, and then the income indicator. And then it says the system value estimate can be no higher than replacement cost, new less depreciation. The field is not populated up above there for that, if that's the comparison. I know that you, book cost less depreciation, I presume, is just not factored for inflation, or if you could explain to me, because in a number of cases, the value estimate is higher than the book cost less depreciation, but we don't have the replacement cost new less depreciation with which to compare. And that's in a number of cases. So I might be just not seeing what I'm looking for. And I know that there's appraiser judgment involved, but if you could explain that, that would be helpful.
Absolutely. Jeff Mitchell for the record. So with these companies, they often have a HIS cost that is on their accounting records, but they have not obtained or provided a replacement cost new, especially with these large unitary companies. And there is not a valuation methodology within Marshall and Swift for us to go on an asset by asset cost for a replacement cost new. And so regulation provides for an out for unitary companies, that if they provide the historic book cost less depreciation, we take that in consideration for the cost approach. The income indication is then also needed according to regulation. If they have not provided that replacement cost new less depreciation indicator, we can't consider it. If they have provided that, then we give that full consideration, and the system value will not exceed that replacement cost new. But because those companies can be on different depreciation schedules with their historic book cost, that's why we see that variation there. Does that help provide some answers there?
Yeah, that it does. I mean, there isn't I guess what I was thinking was that you've got inflationary factors that you're applying on that you compute yearly, but I see what you're saying though about each company has their own depreciation schedule. So that is all the questions I had. Otherwise, I'm good with it.
Hey, any other questions? I'm sorry, Commissioner Rigby, I cut you off. Go ahead, please.
I was just going to make a motion to approve the certification of the centrally assessed rolls.
Commissioner Lippman seconds the motion.
Okay, got a motion by Commissioner Rigby, seconded by Commissioner Lippman. All those in favor, please signify by saying aye.
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 Anyone opposed? Okay, very good. Certification is approved. Executive Director Young, Compliance Division.
Good morning. Now, moving on to the next agenda item, which is agenda item 5 for the Compliance Division. Item A under this agenda item is the department's recommendation to the Commission for the denial of an offer in compromise pursuant to NRS 360.263. That the taxpayer is Eddie Hernandez, and we have Adrian Roberts Larson to provide information. Thank you.
Good morning again, Adrian Roberts Larson for the record. We do not expect that Mr. Hernandez will be participating this morning. Eddie Hernandez has submitted an offer in compromise to settle debt on Sanyo LLC. The business operated from 2010 through 2012 as a Quiznos sandwich shop. The offer is to pay $200 on taxes $17,942.86 on total debt of $37,010.88 with interest calculated through the end of this month. The stated reason for the request is based on doubt as to collectability. Mr. Hernandez states the business did not have the means to meet its tax obligations and subsequently closed. He supports his 4 children and wife on a single income and that the necessary living expenses exceed his income. Based on the analysis of the supporting documentation that he provided in 2018, sufficient grounds have not been established to recommend approval. Specifically, monthly bank statements reflect an excess spent on eating out and over $600 in payments on payday installment loans. Additionally, the bank statements did not reflect any expenses for monthly bills. Finally, Mr. Hernandez is a young man in his 40s, and the offer of $200 is unreasonable. It should be noted that the department received his request in 2018. In 2019, the department mailed a letter to Mr. Hernandez with a counteroffer to pay the remaining tax balance owed. The response due date was October 2019. No response was received from Mr. Hernandez until February of 2020. The department then began receiving similar letters multiple times up to even this past month, in which Mr. Hernandez cited the USC Title 31 and stated no phone calls, please. He doesn't understand the debt and denies the liability owed. Mr. Hernandez signed payment agreements and guarantees in 2011 and 13 for all of the periods owed, and the debt was fully secured by personal liens filed. Additionally, he did acknowledge the debt in his offer and compromise letter in 2018. No updated financial documents have been provided since that time. Therefore, it is recommended that the Nevada Tax Commission deny the offer due to the reason of doubt as to collectability for sales use tax periods ending February 28, 2011 through November 30th, 2012. I'm happy to answer any questions from the commission.
This is Commissioner Wren, Mr. Chairman.
Yes.
I couldn't remember why we deferred this from the last hearing. I know it was on our agenda before, and I couldn't remember exactly why we didn't hear it then and we deferred it to this one.
Yes, sir. It appears that the commissioners did not receive all of the materials for this particular matter, so it was continued until this time.
Okay, good. Thank you very much.
You're welcome.
Thank you. Is there any other questions of Ms. Roberts-Larson?
This is Commissioner Rigby. Ms. Roberts-Larson, is there any other way to contact this taxpayer? It's not a criminal matter, but to have him served or to have another way to contact him? I mean, I'm in favor of denying this and I see that the liens are in place, but it just seems to be, there's such an avoidance going on. Any other way other than when he has to battle the liens to get this moving?
Well, we once this matter is completed today, whether approved or denied, let's say that the commission votes to uphold our recommendation, then the department can start collection actions again, which would be in the form of bank withholds, garnishments on wages, and so on. I have therefore verified that Mr. Hernandez is employed and has been for quite some time. If that answers your question.
That does answer my question, and I definitely would encourage those actions. So I would, if there isn't more discussion, I would move to uphold the denial of the offer and compromise and pursue the debt.
Commissioner Witt, second.
A motion by Commissioner Rigby, seconded by Commissioner Witt. All those in favor, please signify by saying aye.
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 Thank you.
Anyone opposed? Okay, very good. Executive Director Young, next item.
Thank you, Melanie Young, Executive Director. For the record, moving on to agenda item B, which are taxpayers' appeals of administrative law judge decision pursuant to NRS 360.245 and NAC 360.175. The first taxpayer under this agenda item is L Makeup Agency and Institute, and the department has Robert Werbicki from the Attorney General's office. Thank you.
Thank you. Is there someone on the line with L Makeup Agency and Institute?
If you're on the telephone for L Makeup, please dial *9 to raise your hand.
This is Kyle Waugh, the owner of L Makeup Institute. I am represented by counsel, and there was a conversation that he had a hearing this morning, and we were going to be put to the end of the agenda.
Yes, is that still needed?
Oh, Are you there,
Yes,
Shlomo?
actually, this is Shlomo
Yeah.
Sherman, counsel for L Makeup.
Okay, so both of you are present and you're ready to proceed.
Can you hear me?
with the appeal? Yes, I can. So are you ready to proceed with your appeal?
Yes, please. Thank you.
Okay, very good. Would you mind stating and spelling your name for the record? This is your appeal, so go ahead, please.
All right, this is Shlomo Sherman. That's SHLOMO. Sherman, SHERMAN, counsel for L Makeup Agency and Institute.
My name is
morning,
Kyle Wall.
Chairman.
Yes, go ahead and.
May I proceed, Chairman?
Mr. Sherman, could you hold on for just a second, please? Go ahead.
Sure.
The gentleman from L
Sure.
Makeup, could you please state and spell your name for the record, please?
Kyle Waugh, Kyle, Waugh, WAUGH.
Okay, go ahead, Mr. Sherman, and make your case.
Okay, can you hear me?
Yes.
All right. Okay, so I want to start with a 30,000-foot view and point out a couple distinctions that were not made by the department, and then some distinctions that were made by the department that are not supported by the law. And then I'll get into some of the more granular aspects. One of the issues in this case involves materials that are consumed during a course of instruction. Now, there's a big distinction between tangible personal property that remains with the consumer at the end of a transaction and property that is entirely consumed during the course of the instruction. This case turns upon the department's efforts to charge sales tax to L Makeup for makeup kits. And these makeup kits consist of makeup that the students use throughout the course of instruction in how to apply makeup and are consumed by the conclusion of the instruction. Now, this is different, for example, than books, which remain with the student at the end of the course. Books can be resold by the student, and they have a limited independent value. Conversely, materials that are entirely consumed are gone. And at the end of the course of the instruction, there's nothing separate from the instruction itself. And all that remains is the education that the student received. Now, the department provides an analogy from a woodworking course and provides two scenarios. One in which the instructor makes a chair and all the students watch, which, by the way, is a truly terrible educational method. And one in which the instruction assists the students in making a chair. Without support, the department concludes that in the latter case, where the instructor assists the students, the use of the wood would be subject to sales tax. Now, L Makeup respectfully disagrees. But yet, even in the department's example, at the end of the course, there remains a chair, which presumably somebody owns and somebody can resell. But consider, for example, the actual case of L Makeup, where students open their makeup kits and apply the makeup to the faces of their fellow students. At the conclusion of the course, the makeup is entirely consumed, and all that the students go home with is the knowledge and experience of makeup application. This is not something separate and distinct from the educational services themselves. So the case on which this case seems to turn, which is the advanced schools case, did not involve materials that were consumed within the course. And the reason that Elle Makeup cited and attached to its appeal brief several California regulations, even though the department argues that those are not relevant, is because the advanced schools case upon which the department relies was actually brought by the California Board of Equalization applying California regulations. So we provided the California regulations to demonstrate that the very same California Board of Equalization makes this very distinction and treats consumed materials as non-taxable, and critically, even when they are in a separate line item. Similarly, as this appears to be an issue of first impression, we provided the commission with a number of analogous circumstances under Nevada law in which tangible personal property that is consumed in the course of furnishing a service, such as airlines or hospitals providing food to their passengers or patients, they're all considered non-taxable because the food is part of the service. The division tries to make the point that the word materials are distinct from makeup kits, simply because Elle Makeup uses both terms in its line item. But that's not an appropriate distinction because there are some materials that the students use where they need to scoop out of a 50-gallon drum. Those materials obviously cannot be included in a tidy makeup kit, but they serve the same purpose. They are both applied and consumed in the very same way. So the fact that they are given different names in the line item doesn't actually mean that they are different in any substantive way. Another distinction that from the advanced schools case upon which the department relies is the distinction between correspondence courses in which books are the primary source of the instruction and in-person hands-on courses like Elle Makeup in which the books are merely incidental to the live instruction, sorry. The one distinction the department does make and focus on as the most important is the fact that Elle Makeup breaks out its makeup kits into a separate line item. While I acknowledge that having something on a separate line item might be suggestive of whether it is substantively treated as separate, it does not on its own determine separateness. In fact, whether something is on a separate line item is almost always ignored in this kind of situation. And even in NAC 372.045, the only time this concept even appears is in the description of what is a bundled transaction, which is two things. It is when there are two or more distinct and identifiable products, but that are sold for one non-itemized price. And that itself should tell you that whether or not it is separately itemized or combined in one itemized price has nothing to do with whether or not they are treated as distinct and identifiable. In the regulation that we provided from California, the regulation itself says that even if the materials fee is broken out into a separate line item is completely irrelevant. It's still not taxable. So to treat the line item business as being dispositive would elevate form over substance, contrary to all legal authority. In this case, the only reason that Elle Makeup broke out the materials and the makeup kit fees into a separate line item is to show the students that the makeup that they would be using and consuming during the course would consist of high-end materials, not the cheaper stuff, but the really expensive stuff. Not that it was a separate sale. On a related note, nobody, not the students and not the general public, has access to Elle Makeup's proprietary makeup kits, other than in the context of a paid course for which the particular kit is appropriate. So the administrative law judge's finding that L Makeup regularly sells these makeup kits to the public is unsupported by anything in the record. Finally, and with this I will wrap up, a lot of the discussion involves NAC 372.045, which relates to bundled transactions. It is very difficult to understand the administrative law judge's decision because the administrative law judge seems to try to invalidate L Makeup's position that this is not a bundled transaction. L Makeup actually believes that this is one of the exclusions from a bundled transaction under NAC 372.045(2)B, because the true object of this transaction was the education. The makeup is entirely consumed and the students walk away with nothing other than their education. The administrative law judge, though, goes to great lengths to try to show how L Makeup doesn't qualify for this exclusion. To what end, I'm not sure, because surely it's not trying to say that it is a bundled transaction. So that's confusing. The final point I want to make is that whatever tax assessment may ultimately be imposed upon L Makeup, I would ask that the commission consider the fact that the lengthy delay since that tax was initially assessed was not a delay occasioned by L Makeup, and that the penalties and interest therefore should not be assessed against L Makeup as a result of that delay. I hope that you heard all of that, because I'm hearing it echo in my ear and it makes it a little more complicated, but I'm happy to answer any questions you might have.
Okay, thank you, Mr. Sherman. Yes, we heard everything perfectly. Let's see, Mr. Werbicki, do you have a response?
I do, commissioners. Can you hear me?
Yes.
Yep.
Wonderful. Okay. There's a lot of briefing and a lot of documentation associated with this case, but in reality, it's relatively simple. On the L Makeup invoices, course catalogs, and everything else, they break out the costs associated with the course as required to by statute and regulation into a tuition portion and then a line item that deals with makeup kits, materials, books, associated fees. That second portion is a sale. It's a sale of personal property, and it wasn't, tax was not collected, even though the department's position is that it is owed. Tax is simply owed on the sale of that personal property. Then we get into the discussion of whether or not it's a bundled transaction or not. Now, in order for that to be a bundled transaction, you'd have to ignore that separate line item, which just doesn't make any sense. So that's the initial discussion associated with this. And as I stated, it's relatively simple. It's not a bundled transaction because there are two distinct and separate line items. One of them for tuition, which was not taxed, and one for the sale of personal property that was taxed or should be taxed. And as a result, it's quite simple. Once you get into, if the commission were to ignore the separate line item, that's what the bulk of the briefing deals with after that. And again, even under those circumstances, it's simply not a bundled transaction because L Makeup showed that they were able to break out the cost of the makeup kits from the tuition portion of the case. And going again to the taxability of those items, and I point this out in the briefing, is that if a student were to go out and buy the distinct portions of the kit from L Makeup or other stores or whatever else was necessary, they would certainly be taxed on that at those locations. And there should be no distinction simply because it was purchased by this store itself, store and school, that is not subject to a different exemption. And since it is a for-profit institution, it is not covered by any other exemption. Let's see, let me check my notes here real quick. It appears that El Makeup is still relying on a set of California regulations. And of course, those simply have no application here. The case that was discussed, Advanced Schools, is certainly important because of its discussion of mixed transactions in the context of bundled transactions. And parts of that are actually relatively interesting, especially when you consider the different stages of how mixed transactions are used and taxed. But this simply doesn't fall in any of the categories which would make it a bundled transaction where the true object is a service as opposed to being able to break out the goods. The examples that are in a true transaction that the service is assumed, the goods are assumed in the service itself, is artwork, was a typical example, and then also circumstances such as law where the opinion might be placed on paper or something like that, but that's certainly not the object, the true object of the transaction. The paper would be assumed by the service. It finds its way into the service as it's described. Anyway, Advanced Schools was used for that purpose, not the determination of how this would be handled in California, which simply has no application here. Let's see. Oh, and really, that's about it for the delay portion. And the El Makeup consistently was providing additional documentation at a couple of points. The reason why it took so long is that we actually thought that the matter was resolved when Mr. Valari was handling it for the taxpayer initially. And then delays were requested either by El Makeup or on the last one, it was simply because of the COVID pandemic that I think it was taken off the May agenda. Just couldn't get everything put their time for that. And other than, unless the commission have questions, that's it.
Very, very good. Thank you, Mr. Werbicki. Mr. Sherman, I'll give you a couple of minutes for rebuttal. Is there anything that you haven't covered in the past commentary?
Mr. Chairman.
2 minutes.
Commissioner Wren.
Mr. Sherman, go ahead.
Oh, thank you. Yeah, just a couple of things. First of all, I noticed that Mr. Werbicki mentioned almost as an aside that El Makeup is a store, but a store and a school. El Makeup has two very distinct businesses. One is a store in which it sells makeup, and the other one is a school which is separate from the store, and there really is no legal or equitable reason to conflate the two. Everything that we're discussing here is about El Makeup as the school. In terms of the Advanced Schools decision, I think it is absolutely relevant that the Advanced Schools decision was applying a law and a standard and a description of mixed transactions that would absolutely have recognized that consumed materials would have resulted in a different outcome, because California's own regulations recognize that mixed transactions involving consumed materials are different than mixed transactions involving non-consumed materials. All the examples that Mr. Werbicki quoted from the Advanced Schools decision were examples of where the services find their way into property, right? Like with artwork, the artist paints something and then the customer goes home with the painting. So he goes home with property and the services are embedded in the property. This is actually the opposite scenario. This is where the property is embedded in the services. This is where the students get makeup, but they don't get to use the makeup outside of school. They don't get to apply it to themselves, go to a party or a ball or whatever it is. They have to use the makeup in the course of the instruction. And it gets entirely consumed during that instruction. And
Okay,
at the end
thank
of the
you, Mr. Sherman, you're plowing the same ground. You know, unfortunately, we're not in the state of California, we're in Nevada. And I think that's where I'm struggling a bit. So I'm going to bring it back to the commissioners, and thank you for your time and your commentary today. Are there any questions of Mr. Sherman or Mr. Werbicki at this time?
Mr. Chairman, it's Commissioner Brown. I do have a question.
Commissioner Brown, go ahead.
Thank you. The question is actually for Mr. Sherman, and this seems to hinge, in my opinion anyway, on whether or not this is a bundled transaction. So I think for a point of clarification, I'd be interested to know if a student is able to sign up and take the training without the makeup portion, or is the makeup portion required as part of the training?
Thank you, Commissioner.
Shall I answer that?
I believe, can I have my client, Mr. Waugh, answer that question?
Sure.
No. The kits and all the materials, supplies are customized to the program. And actually, as the programs change, so do those supplies. So no, they are hand in glove, mutually. Can't have one without the other. And we don't sell the kits separately to the public either. I also wanted to touch up on one point. Mr. Werbicki had mentioned that we were able to determine how much was charged for the kits. That was done through hours and hours and hours of exhausted piecing together of information. We do not post the cost of these kits as income. It's all posted as tuition. The way that we were able to, I guess, best guess how much, was the makeup kit portion was by pulling up student rosters and trying to attach whatever the value was at that time and whatever the best guess is what the kit that they were using. And this is also confirmed that we do not, the students, when they sign up for a program and pay for that program or finance that program, the kits are not paid for separately. They're not financed separately. It's all part of the total cost of the program.
Thank you, Mr. Chairman.
Thank you. Any other questions from the commissioners?
Yes, this is Commissioner Bursey.
I'm sorry, Commissioner Bursey, go ahead, please.
This question is directed at counsel for the taxpayer. A number of times, and I think that your argument is based on statements like the property, which would be the makeup kits, is embedded in the services, and I think you've said that several times. So I would reference you to, it's page, let's see. One second, I had it and now it's gone. All right, this is page 238 of our materials, and it's titled, the document is titled L Makeup Institute Withdrawal Record and Settlement Calculation Worksheet. And it indicates that when you go down to account information, this is a case of a student withdrawing for medical reasons. And it says that the tuition amount earned is $14,525, which is the total amount that was paid for the tuition. It also says that the makeup kit that was earned is $3,100, where the total amount was $4,350. I'm not understanding if the product is embedded in the services, why the total amount for the makeup kits was not earned. Can you help me with that?
Sure, Commissioner. The reason that it's the refund ends up being that way is because to treat it like a piece of the tuition entirely would pretend as though the makeup kit had been entirely consumed already, even though the student has not actually taken the course. So because the student hasn't consumed a lot of the materials, when calculating the refund, L Makeup recognizes that a lot of these materials have not been consumed and therefore factors that into the refund.
What
I don't know
I'm
if that
not
answers your question, but I hope it does.
Council, is if none of the tuition is being refunded, which to me means that the student got the total benefit of the course, why would not the same be true for the makeup?
I'd like to take a shot at this. Our programs consist of 3 or 4 courses. Each course focuses on a different style of makeup artistry. So the makeup is provided at the time that they start each individual course. So say if, for example, somebody starts the program, they start in beauty, they get all the materials they need to complete the beauty course. Then from there, they move on to, say, body painting, and the same thing applies. The reason why in that example, why we may have earned 100% of the tuition, but still had to refund some of the materials, would be if that student passed the 60% threshold of attendance. And our refund policy, which is mandated by the state, says that if somebody completes 60% of the course, a program or more, no refund of the tuition is due. So in that example, they may have completed 2 out of 3 of the courses. Therefore, they were not assigned the materials for the 3rd course, but they had passed the 60% threshold.
Thank you.
Any other questions?
Mr. Chairman, Commissioner Rigby?
Yes.
I have a question for the state. L Makeup Agency is and the Institute are registered and hold a permit as a retailer for sales and use taxes. Is that correct?
This is Rob Rebicki on behalf of the department. That is my understanding, yes.
And then how much, if you were to, how much of the business is the retail store, retail sales of makeup versus the Institute? If you were to say by dollar amount of revenue to the business as a whole, how much of it is a retail sales in the store?
I'm afraid I can't answer that question. I don't know if someone is on from the department that could.
Or from the taxpayer?
Retail sales account for 5 to 8% of our gross revenue.
And then when you make the purchases of the makeup that is going to be sold or is going to be put together in a kit, you purchase those as exempt sales for resale, correct?
Some yes and some no. Some of the products that we purchase, we pay sales tax for at the time of purchase.
And the reason for doing that is what?
I'll give you an example. We buy 100-pound bags of, it's called UltraCal. It's basically a very fine cement. We use that in our special effects course to create life casts. We purchased that through a local distributor called Nellis Building Supplies. And since they're local, they charge us tax at the time of purchase.
If you were to buy that same item from out of state, would you be accruing use tax on it?
It all depends upon the seller. Amazon's another example. We have to pay sales tax at the time of purchase for everything we buy through Amazon.
Regardless of whether you're a retailer?
Correct.
Okay, and then for going forward, you make a determination when you file monthly or quarterly whether or not those items are or should have been taxed, and then have credits offsetting what your taxes due are, or how are you handling that? I'm a little confused that there's some kind of a disconnect in the understanding of what a Nevada retail permitted vendor is doing. It seems all over the board, whether or not you're providing a resale certificate because you are reselling or you're using materials as a component part of a course.
I understand the the difficulty because it's an accounting nightmare, but this may help clarify it. Everything and Mr. Warbicky will agree. Everything that is sold through the retail store we've provided a resale certificate for those products, so we do not pay tax at the time of purchase. And in turn, we've collected and paid every dollar, every penny that was owed for any retail sales. We don't run kits through our retail store. So all of those items are purchased and allocated towards the school. And so in that scenario, we in turn, each month, we calculate, we separate on our financials based upon cost of goods for what's used in the school. And we keep track of what's taxed and what's not taxed, and then we do a calculation based upon what was not taxed at the point of sale, and then we in turn pay use tax on all those materials that were made part of the school.
So my understanding is that the items of makeup are bought ex tax to be sold at retail in the store. And then when the kits are being made up, the person making up a kit selects items that are already sitting in the retail store area, puts it together in a kit, plus maybe some other things that aren't sold at retail. And then that's the kit that's listed on the syllabus or the course description. So I'm having a difficulty understanding why those aren't retail sales, and they're clearly distinguishable on the list. And I don't understand why there's such an inconsistency in the way that tax is handled. I think it can be very simple or simplistic to deal with it as a retailer, but I think this is being made more complicated than it needs to be by the way the business is being run.
Commissioner Rigby, this is Chairman DeVold. Maybe I can help here. I think Commissioner Brown hit on it early on, but this is really what they're saying is a bundled transaction. Now, if you go back to the Nevada Administrative Code, it's very clear. NAC 372.045 deals with bundled transactions, and it basically says that if the bundled transaction includes taxable products and non-taxable products with regard to the purchase or sales price, these products need to be de minimis. And de minimis is defined as, that means the seller's purchase price or sales price of the tax products is 10% 10% or less of the total purchase or sales price of the bundled products. In this case, it's almost double that number. It's not 10%, it's significantly more than 10%. And at that point, I kind of lose the de minimis value. If it was less than 10%, I would agree with the taxpayer, but in this case, it's not de minimis, it's significant. And it's, if they've said several times it's a bundled transaction. Well, they don't meet the de minimis hurdle, in my view. Does that help?
That helps. My only question is how much of that line item does lab fees amount to? Is lab fees, if it was separated, seems that it would be an intangible non-taxable piece. But I other than that, I agree with you. It's a bundled transaction. The tangible personal property is retail sale, and the portion that is not not taxable. And retail sales tax should have been charged, and that's the way I'm seeing it. I was just trying to see if there was any other explanation.
Commissioner Rigby, excuse me, this is Bill Steves, tax manager.
Yes.
I'm looking at the audit here over real quickly, and just one other point that I want to make sure that is understood. The taxpayer did pay tax on some of the materials that it did resell and include in the makeup kits. The audit gave credit for any areas the tax was paid and made the assessments either on a retail transaction in the store or to the students who purchased a kit and part of their tuition. So the audit allowed for any instances where tax may have been paid already, and those credits were given in the audit.
Okay. All right. That's all the questions I had.
Any other questions from commissioners?
One more for the Department of Tax, a follow-up question, because that was very helpful. Could you see a method to the payment of tax versus the non-payment of tax for the business with respect to the adjustments you made?
This is Rob Werbicki, but I think that was directed at Mr. Steves.
Yes, it was. Thank you.
Good morning, Commissioner Lippman. The audit made adjustments in a number of periods in the audit itself. So this was something that apparently was done, throughout most of the audit period. I'm not saying every month had adjustments, but a majority of the months did have adjustments. And that's based upon their reporting. We gave the credit back where the credit was due.
And just for clarification, that was done, I think, after the original hearing when we were trying to resolve the matter. Some additional documentation was given, and then those adjustments were made based on that documentation.
That is correct. That is correct, Mr. Rubicki.
But did you see a pattern as to why certain transactions were being subject to sales tax and others were not?
That was based upon their vendor. Their vendor was charging them the tax.
I see. Thank you.
This is Commissioner Witt. Just a thought that I had is I kind of viewed this as prepared food. You tax prepared food. We have students that we're preparing to be makeup artists. And so it's a service, but it is taxable. Whereas the food, if you're going to cook it at home and not get the service, is not taxable. So I would move that we support the department in the decision with L Makeup Agency and Institute.
This is George Pelestis. I would second it.
Okay, I've got a motion by Commissioner Witt, seconded by Commissioner Kolessis. I'll uphold the administrative law judge's decision. Any other discussion from the commissioners? All those in favor, please signify by saying aye.
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 Anyone opposed? Okay, thank you for your time, Mr. Sherman and Mr. Waugh. Let's go ahead and
Thank you.
Thank you, commissioners.
Okay, let's go ahead and take a 5-minute break or so. Let's be back at 10:30. Please don't disconnect, and if you could stay online, that would be great.
Yes, hello?
Yes, we can hear you.
Yes. Could you tell me if item already has been approved? Totos Inc. is the name of the company?
It was part of the consent calendar and it was approved.
Okay, thank you very much.
Thank you.
Of course.
I'm unmuting. Hello?
Yes, we can hear you.
Oh, good. Just double checking.
Thank you.
Thanks.
Turn off the
Hello, I'm just checking to see if Hector Camacho's has been approved or not.
Yes. That matter was approved, yes.
Okay, thank you very much. Have a good day.
Thank you, you too.
Hi, this is Bryce with BTO Investments. I was calling in to see if we've had approval for our hearing or when our hearing was coming up.
Yes, that matter was part of the consent calendar and it has been approved.
Okay, thank you.
Thank you.
Okay, I'm just checking to see is the court reporter back at this time?
I'm here.
Okay, very good. Tina, are you back online?
Yes, we're here.
Okay, let's go ahead and get started again, please. Director Young, the next item.
Thank you. Melanie Young, Executive Director, for the record. Moving on, under the same agenda item, which is the taxpayer's appeal of administrative law judge decision pursuant to NRS 360.245 and NAC 360.175. The next agenda item is taxpayer RSVP Elite LLC. And the department has Robert Werbicki from the Attorney General's office available. Thank you. Chairman, you're on mute.
Thank you, I saw that. Thank you. Is someone on the line from RSVP Elite? Please unmute yourself.
Yes, this is Heather Campa. Can you hear me?
I can,
Hello?
Heather. Thank you very much.
Okay.
Yes, I can.
Great.
I can hear you perfectly, Heather. Heather, could you state and spell your name for the record, and then go ahead. This is your appeal, so go ahead and make your case, please.
Of course, thank you. My name is Heather Campa, Heather, Campa, CAMPA. Can I begin now?
Yes, please.
Okay, perfect. Thank you. So RSVP postcards is a postcard deck that advertisers purchase ad space in, and it goes straight from out-of-state printers into deck form to the post office and straight into mailboxes. I feel that when it comes to the mailing list and what the state thinks the mailing list is and what it actually is are two very different things. And that's what I want to clarify today. So myself and the advertisers never get to see the mailing list. We never see it. We never touch it. We never hold it in our hands in the process. So what the mailing list is it's not a list of names and addresses. that I can print out, that I can even sell to a customer. That's not what a mailing list is. It's not a list of names and addresses. It's an electronic direct mail list count. It's even called that on the InFocus software that develops it. It's all electronic. It's developed by me going on to the InFocus website, logging in. They have all of my account information. And I put perimeters in to my list count. So a perimeter would be, I want all of these different zip codes. I want 100,000 houses. And I want the household income to be this amount. I put that into the software. I hit send, and it's done. That's all that I do for the mailing list. Then InFocus software goes straight to the printers, which are out of state, and they work together to print the postcard deck and put the addresses on it. So neither me nor any of my customers have ever seen a mailing list. We've also never even touched any of the postcard decks. This is all electronic, how it works. So I think that's important to note because, and I can give you an example too. I could do a list count where I want to send my postcard deck to 100 homes in the 89138 zip code, starting with the most expensive. I then hit send, and that's where my participation ends. 2 days later, the post office sends me an email saying that they received 100 decks and that I need to pay this amount for them to deliver them to the mailboxes. So again, I think when I look at the state's argument, they say that the mailing list may even be considered proprietary because it's valuable to the customer, but it isn't, because it's not something that they can have. I can't have it. It's an electronic process is what the mailing list and list count is. So statute NRS 372.050 states retail sale or sale at retail means a sale for any purpose other than resale in regular course of business of tangible personal property. My argument here is that the mailing list is not tangible property. So it's also not necessary for the sale, and I'll get into that too, but it's simply not taxable. I also direct to the state of Nevada FAQ on their website. It says, is software, electronic magazine, clip art, program code, or other downloadable material taxable to Nevada residents? The answer is no. Products delivered electronically or by load or leave are not subject to Nevada sales or use tax. Again, my mailing list is sent electronically from the InFocus software to printers. And again, that would mean it is not taxable. Additionally, if I was just purchasing my company today, one of the things I would do is ask all of the other RSVP owners around the nation, what are you charged sales tax for? Because it would be important for me to see and learn. So Eric Myers, RSVP owner in the Bay Area, sent me an email, quote, no, I have never been charged sales tax on our mailing list. It's intangible property that we never take possession of, end quote. Ben Tillery, RSVP owner in Chico, California, wrote, quote, I have never taken possession of anything, including printing of postcards, so I'm not responsible for paying sales tax. The only thing I pay sales tax on are the banners and yard signs, etc., end quote. So I'm not sure if you're aware, but RSVP Postcards is a franchise. We all use the same printers. We all use the same electronic direct mail lists, and we all use the same software that deliver our product. We all have the same exact back-end systems that we all own, and no other RSVP owner pays sales tax on their mailing list. It's also important to note that when I purchased this company, the previous owner of RSVP owned it for 19 years. 19 years. He's the one that trained me on owning this company. He never had to pay sales tax on his mailing list. So if I'm looking at all of the statutes today and I were to be purchasing this company today, looking at the statutes, I still feel that I should not be charged sales tax on this mailing list. State also argues that it was mandatory for the sale. It was never mandatory for the sale. So This is where we go into my background, which I think is relevant. My professional background is that I'm the executive director of Family and Child Treatment, which is a DBA called FACT. We provide free mental health treatment to victims of sexual abuse, child sex trafficking, and domestic violence. I've been doing this for 13 years with this nonprofit. We have to adhere to strict HIPAA regulations. And if it's reported that FACT only adhered to these mandatory, that's the important word here, is mandatory regulations with 90% of my sexual abuse clients, I would lose my license and my mental health facility would be shut down. So my version of mandatory means everybody. And it's always been that way. The state is arguing that the mailing list and service fee were charged to roughly 90% of my clients, and therefore they deemed it mandatory for the sale. The very definition of mandatory by US law states that for something to be mandatory, it's required. It's not optional or subject to discretion. So with that being said, 10% of my clients were never required to pay the mailing list / service fee, which proves it's not mandatory. It was not required for the sale. If it was, then 100% of my clients would have to have been charged. When Governor Sisolak made it mandatory for restaurants to close for COVID-19, he did not say with the exception of 10% of the restaurants. It was mandatory that all of them closed. My mailing list service fee is roughly $1,200 per quarter that I pay in to create. If I had one client, my mailing list fee would cost $1,200. My mailing list fee would still cost me $1,200. If I had a million clients, my mailing list fee would cost me $1,200. So it was always up to my discretion if I wanted to waive that fee for my clients, and I did for many of them, but it was never necessary for the sale I had, and I could have just wrote it off as a software price every quarter. When I have to pay $65,000 per quarter to send out this advertisement, and that's what it costs, roughly $65,000 every 3 months to send this out. This $1,200 mailing list fee is very minuscule and would never make it so that I wasn't going to, I would never lose a client for this mailing list fee, which I only charged the clients $100 for. That's all that I charged each client, $100 on a $4,500 advertising package. If I wanted to waive that $100 fee to get the sale, and I did many times, it was never necessary for the sale, and I waived it. So again, since I waived those fees for many clients, and it wasn't a large expense, it was not mandatory, not necessary for the sale, and so that's ultimately, again, not taxable. Last, I want to talk about my service fee is not taxable in 3.0. The service fee is my conceptual and creative design, my professional development of the marketing piece. My graphic designer, Eric, inserted my design into the software, which made it printable. And that's the graphic design charge that you see on the invoice. I don't know how to use the software to create a postcard. So I would create it. I would talk to him, tell him where to put the banners. I would consult with my client. We would come up with the look and the language, and then I would send the pictures and tell him where to place them on the postcard, what font to use, the colors, the banners, the language, and so on. I created it, and he put my creation into fruition. So NAC 372.130 says, the gross receipts from primary advertising materials produced before reproduction are not subject to sales tax regardless of their form, because the development of these materials for the specific benefit of the client will be considered service. And that's what my service fee was, a service. The statute also goes on to say that consultation, creation of artwork, conceptualization, and so on are not taxable. So the statute also says the sales tax does not apply to an agency fee, service charge, or commission. Therefore, my service fee is also not taxable. In conclusion, I always paid my sales taxes on those fees that I was supposed to pay, and that was on the printing of the postcards. That is what the previous owner had to pay sales tax on. That's what I was trained in, and that's what I paid sales tax on. Again, he owned it for 19 years and never had to pay sales tax on a mailing list or service fee, mainly because it was electronic and it wasn't tangible. So I do feel that that's relevant. I feel that no other RSVP owner across the nation is paying sales tax on their mailing list. I feel that that's relevant. And it's because they're not tangible. We never take possession of them. They are electronic and they're not necessary for the sale. So according to the statutes in the state of Nevada, I feel I should not be charged sales tax on the mailing list and service fee. And that's me concluding. I'm ready to take any questions you may have.
Thank you, Ms. Kappa. Mr. Werbicki, do you have a rebuttal?
I do, Chairman. Again, this one is, I believe, relatively simple. It deals with the concept of what is necessary to complete the sale under NRS 360B.480. Oftentimes, both myself and the department use the concept of mandatory versus necessary, and the ALJ, mentioned that the real standard is whether or not it's necessary to complete the sale. And I believe this presentation by Ms. Campa sort of highlighted the fact that this mailing list was necessary in order to complete the sale. Even if it was only charged, on 90+% of the transactions, it was still necessary for the completion of the sale. Ms. Campa, I'm sorry, I should say RSVP Elite was the one that was basically had access to the necessary database. Essentially, she was the gatekeeper to these businesses being able to send out these advertisements to tens of thousands, or it might have even been hundreds of thousands of homes, which of course is quite valuable. And you can't do that without the mailing list. It would have been a more, interesting argument based on that concept of mandatory. Where is the line on when a charge is mandatory? Is it above 90%? Is it below 90%? But that might be simply academic under these circumstances, because the line item that we're talking about, mailing list and service fee, certainly seems like it was necessary in order to complete the sale under NRS 360B.480 sub C is the one I'm particularly dealing with. Let's see. Again, we don't really have two examples out of California. Isn't really an indication of whether or not RSVP, other RSVP franchises are charged sales and use taxes on a similar line item. We simply have no idea really if that's the case or not, to the extent that it's even relevant. Again, we're dealing with Nevada laws and regulations under the particular circumstances and facts of this case, which the ALJ dealt with all of the arguments of RSVP in her decision, and dealt with and found all of them to be without merit. Ms. Campa discusses the concept of the service fee being something to do with putting together the postcard. There was another line item that dealt with graphic design, and I think that was also charged at over 90% of the charges. I'm sorry, 90% of the invoices. So the service fee is probably something else. And regardless, as with under L Makeup, this is something of a bundled transaction here, because it's not broken out, the mailing list versus the service fee. So it's hard to break out any portion of that for those purposes. Let's see. Really, in conclusion, again, what we're dealing with here is simply a single line item, mailing list and service fee, that was charged on over 90% of the of the invoices. In the context of whether or not that's mandatory or not, that would have been something of an interesting discussion. But as the mailing was described, it certainly was necessary in order to complete the transaction and therefore should be taxable. Given those circumstances, I feel that the ALJ's decision should be upheld in its entirety, and I'm ready for any questions you might have.
Thank you, Mr. Werbicki. Are there any questions of Ms. Campa or Mr. Werbicki at this time?
Mr. Chair, this is George Kalestis. I have a question. Mr. Werbicki, is there the taxpayer, the representations she made, is there anything inaccurate about those?
Not that I'm aware of, Mr. Commissioner Kalestis.
Okay. Thank you.
I'm sorry, Mr. Commissioner Kalestis, I'm sorry. Again, outside of the concept of, I don't know if RSVP franchises around the country are taxed or not. That was not presented at the hearing, and there was no evidence associated with that. But as far as the other matters, it appears to be the same testimony that was given during the hearing.
Thank you, sir. Mr. Chairman, in light of that fact, I would move to, let me see, how would I do this? I would move to overturn the ALJ's opinion in favor of the taxpayer.
And I second.
Okay, I've got a motion and second to overturn the administrative law judge's decision. Is there any other discussion? All those in favor, please signify by saying aye.
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 Is anyone opposed?
Aye. Commissioner Lippman.
Okay, based on the vote, the administrative law judge's decision is overturned. Congratulations, Mr. Campa. Thank you for your time today.
Thank you, commissioners.
Okay, Executive Director Young, next item.
Thank you. Melanie Young, Executive Director for the Department of Taxation. For the record, the next agenda item is the taxpayers, the country store, and the department has Peter Keegan from the Attorney General's office available. Thank you.
Okay, is someone present from the country store?
Yes, good morning. My name is John Bartlett. I'm the attorney for the country store, and I have the owner, Mr. Bombali, here with me to answer any questions.
Okay. Would you mind spelling your name for the record? And then this is your appeal, so go ahead and proceed after you state and spell your name again, please.
Sure. John Bartlett is John. Bartlett is Bartlett. And Mr. Mobali, his name is Obaid, O-B-A-I-D. Mobali is M-O-B-A-L-I-G-H. So in this appeal, there's really one significant issue that is on appeal. There are a number of other ones that were dealt with below to everyone's satisfaction and resolved by the administrative law judge. And the issue on appeal has to do with the determination of the sales tax assessment on one of the taxpayers' two convenience store locations. And it's the one that is referred to as the smoke shop. And both these locations are in Carson City. Both stores offer a similar mix of items for sale, again, in the context of a convenience store. And during the audit, the auditor focused primarily on the other location, the country store location, for a good part of the audit. And the issues in that part of the audit had to do, were basically twofold. One, it had to do with an analysis of the ratio of taxable sales to non-taxable sales by that convenience store. And the second issue had to do with the issue of cigarette buy-down programs that manufacturers offer retailers to compete on pricing. And as I said, there was a lot of back and forth between the auditor and my client, not only on the buy down issue, but also on the ratio of sales. And the reason for that is my client at essentially both locations did not have a point of sale computerized system to track their retail sales. So what he used was a system that he inherited when he bought the country store from the previous owner. And the nature of that system did not rely on sales receipts. It relied on determining, categorizing products as taxable or non-taxable, and then tracking the number of items of each product category sold. And my client would determine the amount of taxable gross receipts by calculating the number of items of those particular taxable items, and plus a mark, that would be the cost of those items to him, and then the standard markup he would apply to each item. And that's how he arrived at taxable gross receipts. Now, the auditor, at the beginning of that audit, and we're talking about an audit period of 2014 to 2017 in the country store, and it's shorter in the other one. The auditor wasn't particularly enamored with that, and that started the back and forth to determine what evidence there was to support the ratio of taxable sales and non-taxable sales. And ultimately, the auditor came and visited that location, and there was a lot of back and forth, and they essentially ended up agreeing on what that ratio was going to be. On the smoke shop, that location only came to light, actually came to the auditor's attention several months into the audit. And the auditor never visited that location, and had the same issue with a lack of sales receipts and whatnot, because again, that location, like the country store, was not using a point of sale system. It was using a markup of cost to calculate taxable gross receipts. Ultimately, during the audit, both my client installed new computerized point of sale systems in both the country store location and in the smoke shop location. And ultimately, the auditor utilized data from both of those point of sale systems to analyze the ratio of taxable to non-taxable sales. So the auditor really didn't consider that much information about what was actually sold or what the taxable gross receipts were during the audit period from actual records, because there weren't any records she thought were sufficient. But she did agree to use the point of sale documentation that was developed after it was installed in both locations during the audit. On appeal, the only issue is the issue of how the auditor came to her conclusion on the taxable versus non-taxable sales on the smoke shop. And that issue can be further broken down to to the information that is in your record as the department's Exhibit M, M for Mary. And if you go to that exhibit, you will see a spreadsheet on, I guess this would be page 107 of the exhibits. You will see an exhibit from the smoke shop for June of 2018 that categorizes the various items of tangible personal property being sold at that location at retail. And again, as Mr. Mobali testified at the hearing, the point of sale system used at the smoke shop was different than the one used at the country store location. The one at the smoke shop was a cloud-based system, and in order to work appropriately, it required Mr. Mobali to input into the system the items of tangible personal property he was selling in his store, and then he would make a determination based on, you know, his long experience of running a convenience store of what items were taxable for sales tax purposes and what items were not. And he entered, by the time we got to this point in the audit where the auditor agreed to look at this information, my client had not yet completed inputting all of each item of tangible personal property that he had on his store shelves for sale at that location. And if you look again at that document on page 107, you will notice that under the taxable part, there's a category called new products. And then down at the bottom of that spreadsheet, there's a category of non-taxable items called new products. And this is ultimately the issue in this case. My client testified that the new products were products that he had recently decided to carry, but had not had the opportunity at that point to input the specific item type into the software. But he had had the opportunity to evaluate which of each of these new products he was going to sell was going to be a taxable item or a non-taxable item. And he categorized them accordingly as shown on the spreadsheet. The auditor and the administrative law judge felt that simply my client's proclivities about categorizing the objects in his and the items in his store for sale as taxable or not taxable was insufficient. They wanted more information on what specific products were in each category. And while my client was able to give examples, he wasn't able to give documentation at that time. As a result, the auditor took the non-taxable new products and considered them taxable. And however, she accepted my client's categorization of the new products that he believed were taxable, and they didn't question those. So that, ladies and gentlemen, is where the difference is between what my client believes was an appropriate ratio and what the auditor believed was an appropriate ratio. Was simply the new products that he had categorized as non-taxable, that the auditor and the administrative law judge decided should be taxable because he didn't provide enough information as to what was in the new products non-taxable column. And you might think, well, what's the big deal? Big deal is it made a very large difference in the amount of sales tax penalty and interest that was assessed in this case. A very large difference. We were very successful in reducing the sales tax assessment on the country store location from what it was to what it ended up being, because the auditor was ultimately convinced that my client's abilities in distinguishing between taxable items and non-taxable items was largely accurate. That didn't buy my client any credit at all when it came to the smoke shop and his testimony that he did essentially the same thing in categorizing taxable products and non-taxable products in that store. Now, on appeal, we're basically asserting that at least the administrative law judge should have given more credit to my client's acumen than was given. And I understand the whole argument about in sales tax audits, of course, and in income tax audits and any kind of tax audit, the documentation is key. However, what we do have is the spreadsheets as to how items were categorized at this location. And we do have my client demonstrating that he pretty much knows what he's talking about when he does do this, and was not given, we believe, the benefit of the doubt. Now, you might say that's not enough, to set aside administrative law judge's decision. My suggestion is this. We would be perfectly happy if the tax commission remanded this back to the administrative law judge for a little more evidence on what products were categorized as new products in 2018, because now all of those items have been input. And we can demonstrate, I think at this point, to the satisfaction of the Department of Taxation and the administrative law judge, that my client's categorizations of these new product categories were accurate. And so that is the position I believe is at this point appropriate to take.
Okay, thank you, Mr. Bartlett. Appreciate it. Let's see, Deputy Attorney General Keegan, are you on the phone? Do you have a rebuttal?
Yes, Mr. Chairman and members of the commission, thank you. Again, as Mr. Bartlett identified, this is a very narrow issue on appeal. It deals with a specific set of products that were not classified as taxable or exempt at the time of sale that were sold by the smoke shop. The only information that was provided by the taxpayer during the redetermination and prior to the hearing, during the hearing, and up to today's hearing does not provide clarification in a categorical manner as to those products, whether or not they were taxable or not. The burden, as the commission is well aware, is on the taxpayer to prove by a preponderance of the evidence that those exemptions were indeed valid. We just have not received any information about the new products. This is not an arbitrary or capricious decision or an abuse of discretion, as the taxpayer claims, by the administrative law judge, but rather an application of the black letter of the law, which construes exemptions against the taxpayer and requires the taxpayer to keep records and receipts, invoices, and other pertinent papers for 4 years from their making. Now, in this case, the transcript reflects, and the taxpayer has identified that he had owned the smoke shop beginning in 2009. He installed the point of sale system in 2016, but was still unable to provide and still has not provided an identification of these new products, which would satisfy the auditor or the administrative law judge. While it is true that the country store had a separate system which was fully categorized and satisfied the auditor, that is not relevant to the smoke shop, which again had this category of new products, which the exhibit referenced by the taxpayer on Bait Stamp 107 is really the only detailed breakdown that was received by the auditor. There were some other months, August through November of 2018, which were handwritten summaries of monthly sales, but they provided no breakdown whatsoever to the auditor of the categories of products that you see on Bait Stamp 107, and certainly no breakdown of the new product list. If you turn your attention to Bait Stamp, well, in this case it's page 18 of the transcript. During testimony on direct examination, Mr. Mobali indicated that the system was switched and put into the smoke shop in late 2016. And it took them about 6 months or over 6 months to get the system running. But the new products were apparently products which were put into the market of the smoke shop on or around that time in late 2016 or 2017, based on what Mr. Mobali identified as a demand increase due to the closure of the adjacent Safeway. There's just no evidence or basis at this point, due to the lack of documentation provided, to justify a remand or to overturn the administrative law judge's decision, which was based purely, again, on application of black letter statutes. NRS 372-155 presumes all gross receipts are subject to tax until contrary established by the taxpayer, and that burden is on the taxpayer. And again, NRS 372-735, which was cited by the auditor and the administrative law judge in her decision, requires the keeping of records for 4 years. So if indeed the new products were available to Mr. Mobali to place into the system sometime around 2016 or 17, there's just no basis at this time to reevaluate or to reinvent the wheel as to what those new products are. There should have been an explanation and demonstration of exemptability at the time of sale, not an estimation after the products were sold as to whether or not they were taxable. The department submits that on that basis, the appeal should be denied and the administrative law judge's decision should be upheld.
Okay, thank you, Mr. Keegan. Is there any questions from any of the commissioners? Commissioner Littman? Mr. Keegan, I'm curious. The offer from the taxpayer to provide detailed information, if we remand this back to the administrative law judge, I agree that the burden of proof is on the taxpayer. They're offering to provide that. I guess it's obviously got to be provided in a format in detail and some kind of credibility that would pass the smell test. I'm confused on why we would not read it. Can you help me with that, please?
Yes, Mr. Chairman. Again, Peter Keegan on behalf of the department. This boils down again to, well, I'll answer your question directly. Up to this point, we haven't heard anything about this. We haven't, so it is at the 11th hour and the 59th minute. So we, and the department is hesitant, though I don't have the opportunity to consult offhand with my client at this time. I am hesitant to prolong this matter any further. I mean, the order on redetermination was issued in November of 2018. So we are approaching, more than a 2-year period of time that's been invested by the department on this. We're contesting a 10% difference in a sales ratio on one part of an audit. The approximated value, based on my consultation with the auditor, between the 95% sales taxability ratio that was found by the auditor and the estimated 85% sales tax ratio requested by the taxpayer is approximately $14,300. The 95% ratio results in a $47,270 principal tax liability, and the requested taxpayer 85% sales tax ratio results in a $33,690 tax liability. It's not a small number, but again, this is a matter which the department has invested a lot of time into, and it would be, in my mind, a shame to string this along further when the taxpayer has had such ample opportunity to provide the documentation which they now wish to have provided.
Thank you, Mr. Keegan. Are there any questions of the department or the taxpayer? Fine.
Could I make a point in response to Mr. Keegan, just briefly?
Yes, Mr. Bartlett, go ahead.
So, Mr. Keegan suggests, that this issue is not that significant. It is very significant to my client, a small businessman who, the amount of money that we're talking about being assessed on the smoke shop is going to be very difficult for him to pay, given the state of the economy these days. And he has paid the country store assessment already some time ago. So, I mean, that part of it was paid. This is a very important issue for my client from a financial perspective, as well as he believes that the reason his audit was taking a long time was not the smoke shop part of it. It was the country store part that took a while. And one of the reasons for that was not the lack of records. It was also a debate going on about the cigarette buy down programs. That was a major part of the assessment as well at that time that the auditor was pushing. And that issue, of course, was an issue that many small cigarette retailers, convenience stores in the state had a direct vested interest in, because if the department's position on that had been upheld, then there would have been a lot more audits of convenience stores, because nobody was taxing these buy downs. So it was a very important issue, and that took some time to work on, and ultimately the auditor and the auditor's legal counsel sent that to the administrative law judge for a decision. So it's not a matter of anyone dragging their feet or not cooperating or in the audit or anything like that took the time. And that was my point earlier, which is the smoke shop part of the audit came at the very tail end of the audit. And we don't believe the auditor spent sufficient time examining the basic issue in this case, as I pointed out. She never did visit the location to examine the product mix. She probably could have gotten a lot of information on what was in the taxable category versus non-taxable category of new products if she had simply visited the store. Instead, my client was reduced to having to testify at the hearing as to what these things were. And it would have been, would have been a lot easier if we would have been able to have spent the time with the auditor before she finalized her assessment on the smoke shop to better educate her about what was going on at that location. So this is a very important issue for my client financially. As of the last billing, which I received, which was this call for interest through December 15th, so I think it was last November. The smoke shop location assessment with tax penalty and interest was $54,000, and it's only gone up since then. So yeah, that is a big issue.
And thank you, Mr. Bartlett. Is there
Mr. Bartlett, yep.
Yeah, go ahead, Commissioner Lippman.
Yep. Thank you, Chairman. Mr. Bartlett, I agree with you. I would imagine that this is a significant issue for your client. So I'm confused as to why your client wouldn't carry his burden of proof. I am confident that the auditors would have reviewed documentation. Taxpayers, without doubt, have the burden of proving an exception to taxation. That's clear. So why didn't he come forward with records? The auditors would have gladly reviewed that.
Yes, Commissioner, the answer to that is that, again, these were new products that had not been input into the system yet. What had been input into the system was Mr. Babali's determination as to whether these new products were subject to sales tax or not subject to sales tax. And he had had long experience in doing that, and his judgment on that sort of thing had been vindicated on the country store part of the audit. And I think given if the auditor had spent a little more time with my client going over the smoke shop product mix, I think the auditor would have been convinced. But by the time the smoke shop became an issue in this case, the auditor was anxious to wrap it up, and my client was unable to have that time with the auditor that they did on the country store location.
Mr. Chairman, may I ask a question?
Yes. Yes, please.
Okay, Mr. Bartlett, the document that you are asking us to consider is a 2018 analysis, which was presented before, but there were some details on it, correct, that weren't categorized. They were new items that had not yet been categorized as taxable or non-taxable, but it's a 2018 document that you're asking us to use as an indication of a ratio that should have been applicable between 2014 to 16. So this isn't really a detailed data that should have been kept during the audit period. This is something you're asking us to consider now because there's further detail.
Well, Commissioner, the auditor agreed to use the data from the smoke shop sales between June of 2018 through November or December of 2018 to calculate an error ratio. So the auditor agreed to use it, and the records from the actual audit period itself, again, were a lot of those documents were lost at some point in time, but the way that the business was calculating their taxable sales during the audit period was a methodology that it's the same methodology being used at the country store, which the auditor had already rejected. So even in doing the country store audit, the auditor was using point of sale information from a period that was after the audit, or at least one small part of the audit period, and extrapolating that throughout the whole audit period. So that was something that had already been established, that the auditor agreed to use the admittedly more accurate information from the computerized point of sale systems to calculate the error ratio.
So I'm just not convinced that that's a very reliable document. It hadn't, as Commissioner Lippman said, been provided in correct detail. I think there's a good system going forward with your point of sale system, but unfortunately the taxpayer failed to produce the documentation and the evidence needed. And this is too late an hour to now tell us that this document that they were trying to allow the company to use has become more reliable now than it was when it was considered at the administrative law judge level. And I would tend to agree with the administrative law judge decision on that. I don't believe that now is the time to prolong this, that this 2018 document can be more reliable now and provide a better ratio. And, you know, it's unfortunate that the system being used back then had not been a very good system and that records were lost, but that's what we have to use. As the Department of Taxation has to base an audit on the best information available. That's been done and completed. A redetermination's been done, administrative law judge, and still we're at this decision point and being told that there was information that could have been, or that's now available. I believe it's too late. That's my thought.
So Commissioner, my client wants to address your point for briefly.
Again, this is Obaid Mubarak. I'm the owner of the smoke shop in the country store. The nature of the business has never been changed. It's just the system has changed. The same product that we used to carry before, we carry the same thing. It is just we didn't have a proper system, proper cash register that would do the right thing, you know, that categorize it. So after we implemented a cloud-based computerized system, everything is going into the proper department. It shows all the items, like if it is a cigarette, it goes to cigarette. If it is a soda, it goes to soda. Before we had taxable, non-taxable, which nobody would understand that what was taxable, what is not taxable. But now everything is categorized properly. So the auditor, when we showed him the country store system, the ratio of the taxable and non-taxable, she agreed on that one, because at the beginning of the audit, she had put in a lot more taxable than non-taxable. So when we provided the information on the smoke shop, because the smoke shop has always been the same way. The name is a smoke shop, but we have about over 6,000 people around our area that needs sodas, needs sandwiches, needs milk and all that kind of stuff. We have a lot more non-tax product. Our non-tax product is about between 15 to 16% of our sales. We pay about $11,000 every month sales tax, every single month, just on the smoke shop. But only 15% of our product is non-taxable. And we have generated the new system, proper reporting, but the auditor did not, at the beginning when we put the system, she agreed to look at it. But when we put in new items taxable, she agreed on it. But when we put new item non-taxable, she didn't agree on that. That doesn't make any sense that you agree on one thing and you don't agree on that other items. So basically we're only about 10% of, 10% of this whole issue is that they're asking 95, we're asking 85. And it makes sense. We sell $200,000 worth of product on a sales a month. We pay $11,000 on a 85% of our product to the state of Nevada. But the nature of the business has not changed. We've been doing it consistently. So I don't know where this 5% is, because she didn't even look at the records properly, and she didn't even come to visit our business to see we carry a lot more product.
Okay, thank you. Is there any other questions from any of the other tax commissioners of the department or the taxpayer?
Mr. Chairman, this is Deputy Attorney General Peter Keene. If I may, just quickly, I wanted to address a couple of things.
You got 2 minutes. I think we understand this perfectly. Perfectly. So you got 2 minutes.
I can do that. I just want to identify in the transcript that the testimony of the taxpayer has been consistent, that the business has been consistent since 2011. They inputted a new cloud-based system in 2016. And if indeed these new products have been consistent, which is since 2011, and it's only changed 1%, then I just don't understand why we don't have records to demonstrate what these new products are, when testimony on page 18 of the transcript indicates that the new system was installed in 2016 and it took approximately 6 months to completely log all of these products. There should have been information as to what these new products were prior to June 2018 and certainly prior to today's hearing. And that burden falls on the taxpayer, and they have not provided it. They say they have it, but if they have it, they should have presented it, and they didn't. The department would request that the ALJ's decision be upheld.
Is there any other questions from the commissioners, or is there a motion?
I would make a motion, Mr. Chairman. Commissioner Rigby, I would move to uphold the administrative law judge decision as to the country store matter.
Commissioner Kolesa seconds.
I've got a motion by Commissioner Rigby, seconded by Commissioner Kolesa. All those in favor, please signify by saying aye.
Aye.
Aye. Aye.
Anyone opposed? Okay, we've upheld the administrative law judge's decision. Thank you, Mr. Bartlett. Appreciate it. Executive Director Young.
You, Melanie Young, Executive Director for the Department of Taxation. Moving on to the next agenda item. This next agenda item is two parts, so we will separate that. The first request is the taxpayer's request for a closed hearing pursuant to NRS 360.247. And the second part to the request is the department's appeal of the administrative law judge decision pursuant to NRS 360.245 and NAC 360.175. So let's take this separately. The first part of this is the taxpayer's request for closed hearing. The department does have Louis Zoka, and the taxpayer is Utah Pacific Bridge and Steel Ltd. Thank you.
Okay, before we go into the closed session, is somebody from Utah Pacific Bridge and Steel on the line?
Yes, Commissioner. This is Nate Runyon with Utah Pacific Bridge and Steel. I'm with the law firm of Holland and Hart, and we also have Jonathan Garlick, who is the controller for Utah Pacific Bridge and Steel. Wanted to address the request. We had initially requested that this hearing be closed, but then Mr. Zoka filed an objection. I've conferred with my client, and my client is fine to withdraw the request so that the hearing can move forward today.
Okay, thank you. I want to make sure that your client understands that we're not going to talk about anything on the specifics of a deal. This is a much larger issue that we wouldn't be talking about an individual project or anything associated with that inside our documents. Is that fair?
Excuse me, I couldn't hear that last part, Commissioner. I apologize.
Yeah, no problem. We typically do not discuss individual detail of a sales contract or anything like that. And I do appreciate you withdrawing your request for a closed hearing. I think that's probably the best. So without objection, is there, well, maybe I should say, is there an objection to accepting the withdrawal for the closed hearing?
Mr. Chairman, members of the commission, for the record, Louis Zoka on behalf of the department, we would have no objection to the taxpayer withdrawing this request. Thank you.
Thank you. Any objections from any of the commissioners?
Do you need a motion?
Ms. Bordelove, do we need a motion if they withdraw? I don't believe we do.
You don't, if they're withdrawing, you don't need a motion.
Thank you. Okay, very good. Okay, let's go ahead and proceed then at this point. We've got an appeal from the administrative law judge's decision from Bridge and Steel. Go ahead and make your case. And again, if you don't mind, please state your name and spell it for the record.
Mr. Chairman, I'm assuming this is for me since we're the one who are appealing the ALJ's decision. At this point, I assume the commissioners have seen our brief relative to this issue. So what I would like to do is just highlight some significant points in that brief relative to the reason that we're here today. The first point I'd like to make is that nothing absolutely nothing under Utah law requires Nevada to reach the conclusion that the ALJ has reached in this particular case, and looking at Utah law and Nevada law. And first, I want to just explain the similarities between Nevada and Utah. In Utah, just as in Nevada, if you have a construction project in that state, as the construction contractor, you're going to be required to pay a tax associated with that project. Then in Utah, just as in Nevada, if your construction project is assembled in that state, but then ultimately completed in a different state and attached to real estate in a different state, you're going to be exempt from the tax. Again, I repeat, just as in Nevada, you will be exempt from the tax under their statutes if you complete that real estate improvement project in a different state. And that's exactly what happened here. All the improvements to real estate occurred in Nevada, not in Utah. Now, here's one point, though, where Utah and Nevada is different. Utah has this, what I would call, clawback provision, which says that where the other state allows a credit for sales and use taxes imposed by the state of Utah, then they're going to collect a tax. So this puts squarely within your lap the decision whether or not we're going to allow an exemption for this project, because Utah itself says they're only are going to assess a tax if the other state allows a credit for the sales and use taxes imposed. So as I will explain in a moment, I think that one of the fundamental flaws with the ALJ's decision is that it puts the cart before the horse. It assumes that the transaction is taxable under Utah law without actually analyzing whether there's an exemption that's available, whether the Nevada law requires that be a refund paid here in this case to the taxpayer. Now, looking at the provision here, we're interpreting for purposes of this circumstance, NAC 372.055. And before looking at the specific language, the couple of things I want to note here is that the burden of proof is on a taxpayer to show that there should be a refund in this case, so number one. And furthermore, relative to the interpretation of NAC 372.055, the Nevada Supreme Court in the City of Reno case, 118 Nevada 889 said, great deference should be given to an agency's determination when it is within the language of the statute. Again, great deference should be given to the agency's determination. Now, the language of the regulation says that Nevada will provide credit when a sales tax is legitimately paid. A sales tax is legitimately paid. And that was not the case here. This was not a transaction where Utah Pacific assembled a project, paid sales tax and the various subcomponents of it, and then brought the project over to Nevada installation to the real estate in Nevada. Instead, what happened was, ex post facto, only after the taxes had been paid in Nevada, project was cleaned. Much, much later, Utah decided all of a sudden, wait a minute, Nevada has this provision, NAC 370.055, we're going to go ahead and tax the transaction. So it's not a sales tax that was legitimately paid in connection with the build out. It was a much later event that Utah decided to try to take advantage of. Now, I also would like to call your attention to a prior ALJ decision from 2010, and this was Viper Steel. And in Viper Steel, the Nevada Tax Commission, this was decided April 23, 2010, the Nevada Tax Commission reversed the ALJ. And here's one of the things that the Nevada Tax Commission said at that time relative to the law. When the property is delivered to the purchaser in this state, it is immaterial. Again, it is immaterial that the contract of sale called for the shipment by the retailer of the property to a point outside the state. The property was made to specifications for out-of-state jobs. Prices quoted included transportation charges to out-of-state points. Goods are delivered to the purchaser in the state via route, a portion of which is outside the state. So in Viper Steel 10 years ago, it was clear that a real estate improvement project completed within the state of Nevada was taxable within the state of Nevada. And that's exactly what the department did here. I would also note that at the time that this project was bid for and the funds were placed into escrow for the project, pursuant to NRS Chapter 338, the contractor here, Utah Pacific, had to represent that it was going to comply with all Nevada requirements, which included the collection of the sales taxes. There was no surprise here that the sales tax would be due in Nevada. In fact, it was collected for Nevada, and it was deposited with the Department of Taxation. Again, it was much, much later under an ex post facto act that Utah decided to opportunistically, again, I think this is what they're doing is opportunistic, decided that they're going to read this Nevada provision and say that under that Nevada provision, now they're entitled to the tax. The problem with that rationale is that you get to say what the Nevada provision requires, not the state of Utah. You decide what NAC 372.055 ultimately requires and whether that allows for a refund in this case. It's not Utah's ability to force an exemption down our throat by saying that this transaction should be taxable in the state of Utah, not in the state of Nevada. When in fact, all the improvements to real property took place in the state of Nevada. And taxing it in Nevada is, again, consistent with Viper Steel. Finally, if you look at the language of the statute, of the regulation, NAC 372.055, it says, sales tax legitimately paid. And when you look at the way that this was being collected, this is attempted to be collected by the state of Utah, this is not a sales tax. A sales tax would have been if this particular contractor walked into, let's say, a Home Depot or some major store and had to pay a sales tax in Utah at the time of its purchase. That's not what's happening here. What's happening here instead is Utah ex post facto is trying to finesse this transaction for its own benefit. But even at this point, the state of Utah is what they have done is they have decided that they're going to hold this process in abeyance, as the ALJ found it herself. They're going to find this process in abeyance until they see what Nevada does. So because there is no sales tax here legitimately paid in Utah, I would ask you to interpret the provision of NAC 372.055 the way the department did, which is there is no refund due here. Taxpayer is not entitled to a refund. And those are my comments. Thank you.
Thank you, Mr. Soka. Is there a representative from Utah Pacific that would like to make a presentation?
Yes, Commissioner. Nate Runyon, RUNYAN, with Holland and Hart, on behalf of Utah Pacific Bridge and Steel.
Thank you, Mr. Runyon. Go ahead.
Thank you, Commissioner Chair and Commissioners. We appreciate being able to present here. Utah Pacific Bridge and Steel, or I'll refer to them as Utah Pacific for shorthand, believes that the administrative law judge's decision was well-reasoned and should be affirmed for the reasons set forth in that opinion, and also the arguments made by Utah Pacific in its pre-hearing brief and in the hearing before the ALJ. I'll briefly outline those reasons and then address the arguments made by the department in its brief and also by Mr. Soka this morning. First, I just want to make a note that there's no dispute on the facts, and the department has not argued any of the ALJ's factual findings are incorrect. So, we agree with the basic recitation. Both parties made similar recitations, but I want to give a little background because Mr. Soka didn't get into that. Utah Pacific is in the business of constructing bridges. It makes purchases that are delivered to its facility in Utah. It has no facility in Nevada. Its only facility is in Utah. All those purchases are made from outside of Utah or within Utah, and all purchases are delivered to Utah. And then Utah Pacific takes those raw materials and fashions them into a bridge in Utah, which is a key factor that the ALJ made. Utah that was a finding of fact. Utah Pacific then transports those constructed portions of the bridge and erects them in place, converting the bridge to real properties. We have no dispute that the erection and the conversion of the property happened in Nevada. Utah Pacific paid the taxes to Nevada and was later audited by Utah. Utah came in and assessed Utah Pacific Bridge, and Utah Pacific Bridge paid the tax to Utah and also appealed that assessment. As it stands, Utah Pacific has paid the taxes at issue to both Nevada and Utah, and there's no disagreement on that point. Regarding the burden, the ALJ ruled the Utah Pacific met its burden in this case. The burden now shifts to the department to demonstrate that the ALJ was in error, and we believe the department has failed to meet that burden. As Mr. Azoka explained, the key consideration here is the interpretation of NAC 372.055, and we agree 100% that it is this commission's legal determination on that administrative rule that is important and key to the determination in this case. And it states, in determining the amount of use tax that is due from a taxpayer, the department will allow a credit for the amount due to the state in an amount equal to sales tax legitimately paid for the same purchases of tangible personal property to a state or local government outside of Nevada upon proof of payment deemed satisfactory to the department. So first on that last point, there's no dispute on the payment to Utah. The department hasn't raised any issue that it was not satisfactory proof of payment that was provided at the hearing. So the ALJ held that Utah Pacific legitimately paid the sales tax to Utah, and thus a credit should be allowed. And to reach that conclusion, we do need to look at Utah law to see if Utah Pacific legitimately paid that tax under the wording of NAC 372.055. Utah law says a sales and use tax is imposed under Utah Code subsection 59-12-103 subsection 1L. And that states a tax is imposed on the purchaser as provided in this part on the purchase price or sales price for amounts paid or charged for the following transactions. And then there's several transactions that a sales and use tax is imposed on in Utah. And subsection L says amounts paid or charged for tangible personal property if within the state the tangible personal property is 1, stored, 2, used, or 3, consumed. And Utah, the auditing division for the state of Utah came in and found that Utah Pacific had taken the materials, had used those materials to fashion a bridge, and that work constituted a taxable event in Utah far before these materials made it to Nevada. So the question was, is a tax first imposed by Utah, is that a valid or legitimate tax? And the ALJ said, yes, it was. The ALJ recognized the first incidence of tax was in Utah. The purchases were made there. The materials were sent there. The bridge was fashioned there. In the briefing and in our hearing, we addressed the case law that Utah has that's on its books by the Utah Supreme Court, saying that in this circumstance, a tax would be due in Utah. And I'm not going to belabor the point, and you can look at the language of the Utah cases and our argument that the ALJ accepted. The ALJ looked at those cases, cited those cases in the decision. So we're not going to go forward and cite to everything and read everything, but the ALJ accepted that and found that the tax was legitimately paid to Utah. Now, the department argues that the tax paid to Utah was not a sales tax. Department made the same argument in its briefing before the hearing at the ALJ and at this hearing as well. The ALJ dismissed the arguments, finding the department guidance indicates it was a credit for sales and use tax, and to hold otherwise would be a violation of the constitutional analysis that the ALJ provided. The ALJ went in and talked about the Commerce Clause and the implications of what the department is arguing. And I don't want to get into that because it could take a long time to talk about the Commerce Clause analysis, But if the department's determination were set forth and upheld, that would be a violation of the Commerce Clause. And I can address those points. That's in our brief. I just don't want to belabor the point and take more time on something that we've already briefed. But even with that said, under Utah law, the tax was a sales tax. Under Utah law, under Chapter 12 of Title 59 of the Utah Code, the tax imposed is a sales and use tax. There's not a separate chapter for sales tax and a separate chapter for use tax. Nevada has separate chapters, Utah doesn't. It's all in the one chapter. So the imposition under 59-12-103 is a sales and use tax. Historically, Utah did have a separate chapter for sales tax and use tax. And that was the case from 1937 to 1987. But then in 1987, the Utah legislature amended the statutes and combined the sales and use tax into one chapter. And that's what was imposed here. There's also evidence in the record. The exhibits that were submitted, exhibits 1 and 2, were the audit report from Utah. At the bottom of each of the schedules for the audit report, there was a notation that says Utah sales and use tax audit. It doesn't say sales tax audit or use tax audit. It's a sales and use tax audit. This was not solely a use tax. It was a sales and use tax. So their argument by the department that this is not a sales tax. This is just legally incorrect under Utah law. Again, the department argument would also present a violation of the Commerce Clause of the U.S. Constitution. We addressed this in our brief and can address it now if you'd like, but we would just leave it at the arguments that we made in our brief, that if you distinguish between the sales and use taxes the department's trying to do, you've now disjointed those taxes and they're no longer complementary. And now you would give a credit for sales tax paid based on the nexus of the vendor. And that's inappropriate. It would be an arbitrary decision and it would be a violation of the internal consistency requirement under U.S. Supreme Court precedent, because then you have a scenario where if the vendor has nexus in a state, they would charge a sales tax, but if they have no nexus in the state, it would be a use tax accrued by the purchaser. Well, that would be an arbitrary determination and you would be distinguishing based on an interstate issue, which is the state of residence of the vendor. And that would be wholly inappropriate. And the ALJ agreed and found so in its decision. Next, the department makes a novel argument that was not raised before the ALJ, citing the department publication in the ALJ's order. The department claims that a credit is not allowed if the other state's tax is less than Nevada. Now, Mr. Soka didn't argue that here, so I don't want to belabor this point either, but in his brief, the department said that if the tax paid to the other state is less than Nevada's tax, no credit is allowed. And it says that that's long-standing practice of the department. That argument was not raised at the ALJ hearing. And I suspect that if it was the long-standing practice, that would have been raised, and we certainly would have addressed it. That didn't happen. Utah Pacific should get a credit of only the taxes paid to Utah. You can look at the ALJ's decision. Page 9, the ALJ discusses U.S. Supreme Court precedent and states the court recognized that because a use tax is generally levied to compensate the taxing state for its incapacity to reach the corresponding sale, it is commonly paired with a sales tax and is applicable only when no sales tax has been paid or subject to a credit for any such tax paid. Thus, the state of purchaser or for first use impose the tax and no other state taxes the transaction unless no prior tax has been imposed or if the tax rate of the prior taxing state is less, in which case the subsequent taxing state imposes a tax measured only by the differential rate. And that's exactly what happened here. Utah Pacific paid the tax to Nevada. It was audited by Utah. It paid the tax to Utah. It requested a refund of only the tax it paid to Utah because the rate in Utah is lower. So the differential is still paid to Nevada. Nevada retains the differential of the rates, but the credit is only allowed up to what is paid to Utah. Now, if the tables were turned and the rate was higher in Utah, the credit would only be up to the amount that the tax would have been in Nevada. So that's what that's talking about. You don't get a higher credit than what would be paid in Nevada. And that's what that publication is talking about. Again, that point was a new argument raised, not raised before the ALJ. The department also argues at page 11 of its brief that the incidence of taxation is the residency of the purchaser. And we have no disagreement with that. The residence of the purchaser is Utah Pacific Bridge, and that's in Utah. Purchases are made in Utah, and the materials were used to construct bridges in Utah. And that's what the ALJ, agreed to that. The department also argues, he didn't raise this point, but argued in its brief that that there's no multi-state compact here, so there's no requirement to give a credit. There's nothing in NAC 372.055 that says you have to have a compact to get a credit. It lays out the language. If you meet the requirements of NAC 372.055, a credit will be allowed. And that's what we're here to determine. We believe that Utah Pacific meets those requirements. The department makes another argument that Utah Pacific takes exception to, and that was alluded to by Mr. Soka. It states in its brief, indeed, the Utah authorities are holding this process in abeyance in apparent attempt to see how the state of Nevada applies its own laws relative to the issue of an exemption. So the implication by this, and also by the argument by Mr. Soka here, is that Utah and Utah Pacific Bridge are dragging this out to see if they can take advantage of Nevada law and get a credit in Nevada first. We don't believe that's the case. And we believe they're incorrect for two reasons. First, when this came up, Utah Pacific reached out to the department and said, look, we understand there's an issue here. We'd like to mediate this between Utah and Nevada and see where we can get. The department declined. They would not mediate this case. Then Utah Pacific asked the department, okay, well, we have this case pending before Utah and Nevada. Would you please stay the case in Nevada and allow us to address this in Utah? And the department declined. Again, we requested and submitted a stipulated stay for this appeal. And I can give you dates if the commission would like, but we submitted a stipulation to stay the case. And in August of 2019, the department responded to Utah Pacific and said, no, we are not going to stay this case. We want to go forward to hearing. So to say that the taxpayer in Utah are trying to wait, trying to push this appeal and go first, we believe that's not accurate. We tried to have this appeal stayed while we move forward with Utah. Finally, the department's argument on page 13 of his brief regarding NRS 338, and that Utah Pacific is certifying that it will pay taxes in Nevada. The statute cited by the department does not have a requirement to pay taxes that are not due. So we have a problem with those two statements, because first, the department is presupposing that its interpretation is correct. And we're here for the commission to determine whether the credit should be allowed. And if it is allowed, then Utah Pacific will pay the tax based on the final determination after all appeals are exhausted. And the second reason that this is incorrect is the tax has already been paid to Nevada. Our request here is that a refund be issued based on the language of NRS NAC 372.055. So Utah Pacific is in no way in violation of NRS 338. In any event, my understanding is that the tax commission wouldn't necessarily govern contractor licensing issues. It certainly has jurisdiction to review the taxes for credit paid, the credit for taxes paid in this instance, and that's appropriate. But the contracting issue, we believe, is a red herring. So the last point that I'm going to make is that the department says that Utah is inconsistent with Nevada, but the law is the same, and we respectfully disagree. NAC 372.055 is different, has different language than the Utah statute in place. The Utah statute is in subsection 5912.104, subsection 58, and that subsection says that an exemption will be allowed for purchases if a credit for taxes paid to another state is not allowed. So the real question is whether 372.055 allows a credit or not. And if a credit is allowed, then there's no exemption under Utah law. If the credit is not allowed, then Utah should allow an exemption. But the first inquiry is whether NAC 372.055 does allow for a credit for taxes paid in this scenario, and the ALJ found that it did. Now, the department also argues that if the tables were turned, it would not impose a tax. And that's admirable. We appreciate the representation by the department here, but unfortunately, Utah did impose a tax. And because Utah imposed a tax, NAC 372.055 applies and should allow credit for taxes paid here, as the ALJ found. So in closing, we ask the commissioners to respectfully construe the Utah law as written and interpreted by Utah courts as the ALJ found, and allow the credit for taxes paid as required under NAC 372.55. This tax was legitimately paid under Utah law as the ALJ found, and also this was a sales and use tax as pursuant to Utah code. Therefore, we believe that a credit should be allowed, and any arguments to the contrary would be a violation of the Commerce Clause and would be inappropriate and result in an arbitrary result. And therefore, we request that the commission affirm the ALJ's decision. Happy to answer any questions.
And thank you, Mr. Runyon. I appreciate it. Are there any questions of Mr. Runyon?
Mr. Chairman, may I do a quick rebuttal?
2 minutes.
Thank you. Thank you very much, Mr. Chairman. The first point I want to make real quickly is the fault here really does not lie with the taxpayer. The fault lies here with the state of Utah, because the taxpayer obviously is in a difficult position between the two states, but it is the state of Utah that's relying on its clawback provision, look into the exemption in Nevada to say that now they're able to tax this particular taxpayer. So that's the first point I'd like to make. The second one is relative to this whole argument on the Commerce Clause. The constitutional constraints on taxes have been construed in Nevada courts. They are quoted in our briefs, and I don't want to take up too much time, but one of the provisions I would call your attention to is State v. Baxter, where the Nevada Supreme Court says that double taxation occurs only when there's an imposition of tax, the same tax by the same taxing authority on the same subject matter. There is no double taxation where the taxes are imposed by different states. That's what the Nevada Supreme Court said. On the issue of the use tax and incident of taxation, here I think this is worth quoting here. The incident of taxation of the use tax is the residency of the purchaser. And so here the purchaser for the bridge was a Nevada entity, and the bridge was installed in Nevada. Now, this whole issue and the new argument on the ALJ's analysis relative to one of the points we raised in our brief, which is that the taxes paid out of state must have been equal to or greater than the sales or use tax. We had to use that because the ALJ in her own reasoning quoted that provision. So we wanted to point out that the ALJ only reads part of that particular provision, but not the entirety of the of the interpretation provided by the department. She ignores part of that interpretation, which says it must have been equal to or greater than. And again, going back to the idea of a sales tax is imposed either contemporaneously or ex ante on a transaction when it occurs. This was an ex post facto at much later, probably a year later or more, where the state of Utah decided, we're going to go ahead and tax this transaction because there's this potential exemption in Nevada. Now, one of the things that the counsel for the taxpayer said is that they've asked for a stay. How could we agree to a stay when the Utah provision being relied on says that the other state is what the Utah language is in their statute? The other state allows for a credit for the taxes imposed. Well, we had to make it clear that the Nevada department was not allowing for an exemption. And that was the reason we could not agree to a stay. And that's all the comments I have. Thank you very much. Ready for questions. Thank you.
Thank you. Are there any questions of the taxpayer or the department at this time?
Mr. Chairman, it's Commissioner Brown. I just have a couple comments, if you don't mind.
Please.
Thank you. A couple observations I made is that, some of the arguments seem to be focused on whether it's sales tax or use tax. And I'm of the opinion that two things. Utah combines them, so I think there isn't a distinction there. The other thing that's a bit troubling to me is the statute appears to conflict with the department's publication. The department's publication T0I01.02 states the credit for sales or use tax paid. So I think that there seems to conflict, and if the taxpayer is relying on the department's publication, certainly, even if the argument's made that it's use tax and not sales tax, the department states in that publication it's allowed. I think the fact that Nevada would not apply a tax if the situation was reversed is really not relevant in this matter. That this is what's going on in Utah, and I do believe, though, my personal opinion is I would support the ALJ's opinion, but I would condition that on the matter being finally adjudicated in Utah. So in the event that there is a change to what is appearing to happen in Utah, the taxpayer is not relieved completely of the tax if it would be paid in one state or another. Thank you.
Commissioner Rigby, I have some questions.
Go ahead, Commissioner Rigby.
I have a question for Mr. Runyon. When the taxpayer purchased the raw materials needed to fabricate, and you're calling it fashion, I don't know if that's a term of art in Utah law, but when they purchased the raw materials, whether from within the state of Utah or outside, they provided a certificate that exempted those sales. What type of certificate were they using? Was it resale certificate? Was there a manufacturing exemption? What was the exemption certificate that was being provided?
Commissioner, that's a good question. I think my understanding is a number of them did not have Nexus in Utah. And so that would be the reason for a number of the purchases. There would not be Nexus in Utah for them to collect because they were outside of Utah. As to other purchases, that's a good question. I don't know if it was a resale or not. That wasn't addressed before the ALJ. Mr. Garlick, if you're on and you know the answer to that, please chime in. I would appreciate that.
We do have a resale thing, and also for manufacturing. We use them kind of both in the same, because we do sell some bridges for a sell. Like we do two ways. We do one erection in place, and we do have them that we sell and just give it to them, and whoever does it erects them themselves. So on those ones, we do classify it as being sell. On the other ones, it is classified as use, and that's what happened in this case in Nevada in these jobs.
Okay, so if I'm asking on this particular contract, you had a contract to construct a bridge in Nevada, And for this particular contract, you provided a resale certificate when you bought the raw materials. When you bought the materials, they were bought specifically for this bridge, correct? They weren't bought for multiple. Okay, so you bought them specifically for this bridge. You then use the raw materials, and my understanding, the terminology should be fabricated them into girders, or is it a girder, a truss? You fabricated those in Nevada with the intent that they were going to be finally used in, you fabricated them in Utah with the intent that they were going to be used in Nevada to complete a real property item, correct?
Yes.
They were moving through Utah in interstate commerce for the purpose, from the very beginning to the end, for the purpose of completing a real property in Nevada of a bridge. So that, I just want to make sure I'm clarifying that.
Yes.
You don't just manufacture a whole bunch of girders and then sell them as girders. You're not selling them from Utah. So the entity, Utah Pacific Bridge and Steel, is a licensed Nevada contractor, correct?
Correct.
As a licensed Nevada contractor, this company is also required to hold a sales and or use tax permit, a consumer use tax permit, or a sales and use tax combined. Either way, you're under obligation to collect or accrue and remit sales and or use tax to the state of Nevada, correct?
Correct.
Okay, so just speaking within the boundaries of the state of Nevada, a contractor in Nevada is considered the consumer of the materials and supplies that they provide in completion of a real property project, correct? So when that was done, and in other instances when it's been done in Nevada, the use tax was correctly accrued for the materials and supplies that were purchased to build the girders and remitted to the state of Nevada. So I am now, fully understanding that the way you did it to start with was correct. You used a resale certificate. The goods moved into Utah, were fabricated there for the purpose of continuing their storage, use, or consumption in the state of Nevada. So your language in your statute is stored, used, and consumed, and the language in ours is storage, use, and consumption. That's the same concept. The final use, the final storage, or the final consumption is the state of Nevada. So this for our purposes would not have been, it would be correctly assessed in the state of Nevada at the full amount. What the state of Utah does is their own set of laws. That doesn't dictate to Nevada what Nevada is required to do under our laws. So if the state of Utah, if I were representing this taxpayer, I would be looking at this as you're moving in interstate commerce, you can't tax it. But if they choose to tax some sort of activity there, as say the manufacturer of the girder, that's a separate business decision or a decision that the Utah Tax Commission could make that doesn't conflict with what Nevada is required to do and doesn't require that Nevada provides a refund.
Commissioner, might I respond to that briefly?
Yes.
We completely agree with you that absent Utah imposing a tax here, that the tax, a use tax, would be proper and should be imposed on Nevada, Utah Pacific Bridge and Steel in this case. And in fact, Nevada did receive the tax. Utah Pacific filed its returns, paid use tax on all those purchases. Now, the question is whether now that Utah has said, you know what, you need to pay a sales and use tax in Utah because of the instance of tax was in Utah before there was any incidence of tax in Nevada, before the materials got to Nevada. And under 59 12 103 1L, under Utah law, the tax is due. And I can point you to the case that says that in Utah, and it's the Chicago Bridge and Steel case. And the court said the reason for this rule, the contractor rule, which we've been discussing, which Utah and Nevada both has, is that materials are purchased and then converted into real property would escape the sales tax because a sales tax is not imposed on the sale of real property. Real property contractors are therefore considered the consumers because their purchases of materials that are incorporated into real property are the last transaction in which those materials can be subject to the sales tax. I think we can all agree to that. That's what we've already discussed. This last point is what's important. The court said, even if a real property contractor incorporates the materials into real property in another state, the purchase in Utah of those materials is still taxable. So under Utah Supreme Court precedent, the auditing division's assessment here was correct. And that purchase came to Utah. And another important factor is the bridges were constructed in Utah. If they just came here and then nothing was done here in Utah, they just were stream of interstate commerce. They came here and then they went immediately to Nevada. I think that analysis would be absolutely right. Utah would have no right to tax the purchases. But where the purchases were made and sent to Utah, the materials were used to construct the bridges in Utah, and then they were shipped to Nevada. That instance of tax under Utah Supreme Court precedent occurred in Utah, and the tax is due in Utah. Then we have to look at NAC 372.055 to see if a credit should be allowed. And so if the materials came to Nevada first, it'd be an opposite analysis. And who is allowed to tax those purchases first? Well, in this case, and I think it's consistent with the Nevada Supreme Court decision that the residence of the purchaser is what you look at, and that is Nevada. That is Utah. The operations and the facilities where the bridges are constructed are all in Utah. So
which is that construction?
This is in Utah.
Mr. Chair, this is George Colesis. Sharon, can I just step in for a second? But what if you listen to what Commissioner Rigby has said, her analysis is actually very thorough and goes directly to the point, which is your problem sounds like it's a problem with the state of Utah, not the state of Nevada. And I don't know why that burden is now being placed on us. I mean, the analogy you gave is they manufacture a car and they assemble a car in the state of Texas. They sell it here in Nevada. We still charge tax. The finished product comes here. So what if the materials were in another state? So, I'm listening to what Commissioner Rigby has said and comparing it to what I've heard from the attorneys. And frankly, if Commissioner Rigby is going the way I think, I absolutely agree with her.
Well, could I respond to that as well? That has to do, the difference in your scenario with a car manufacturer is that the contractor rule doesn't apply. And so the contractor rule applies and makes the contractor the consumer. And now the question is, when are they the consumer? Under the statute and the case from the Utah Supreme Court, and that's the whole issue, is whether the tax was legitimately paid to Utah under NAC 372.055. If that was legitimately paid to Utah, then Nevada, under the regulation, must allow a credit for taxes paid. And that conversion or that incidence of tax occurs when the taxpayer takes those materials and fashions or fabricates, whatever verb you want to use, creates the bridge in Utah. And so Utah imposes the tax there. If that tax wasn't imposed and wasn't legitimately imposed by Utah, absolutely there would be no credit here. But under Utah law, and based on the language of NAC 372.055, if the tax is legitimately paid, and under Utah law it is, then a credit must be allowed.
No. Chairman DeVol, this is Bill Steves, tax manager.
Yes, go ahead, please.
Can I say a few things here? I got to correct the record here. This, we're being told not an incorrect scenario here. Utah Pacific Bridge and Steel has the potential of wearing two separate hats. Okay, in one hat, they are a construction contractor in the state of Utah, where they go and make improvements to real property. They also have a hat on where they manufacture steel products for contracts in other states, specifically Nevada, California, Idaho, and Arizona that I know of. Okay, they are a step in the process in the performance of a construction contract. Okay, if we look at what the definition of a construction contractor is, they're not performing as a construction contractor relative to the work to the Nevada bridge. They are not performing in any way, shape, or form, making improvements to real property. There is no bridge in Utah. This was steel that was fashioned, dry fitted on the ground, put on a truck, and fixed to real property here in Nevada. Okay, anytime you drive from the McCarran Airport onto the 215, the bridge that you're driving on is that steel. In order for me to not tax this material that came into this state, I am in violation of many more statutes than just allowing a misapplied NAC 372055. There are many other things I'd like to say here, but I need to make sure that that is correct. They were not a contractor in Utah relative to Nevada. They were a manufacturer of steel products. They made the election of all the related materials to be delivered to Utah, put on a truck, brought to Nevada, and performance of their contract as a subcontractor.
Okay, thank you, Mr. Steves. Other commissioner comments? Anybody else have anything else? Mr. Littman?
I'm ready to make a motion, but I'll defer to other comments.
Are there any other comments or discussion at this point?
I just wanted to make one last comment. Sales and use tax, and I'm not like Commissioner Brown, so I'm not too concerned about whether it's termed as sales or a use tax. We're talking about a transaction tax. We're not talking about an activity tax. The transaction tax. We don't have a value-added tax here. A value-added tax analysis seems to have been applied. So we are talking about sales and use tax. We are the Nevada Tax Commission, so we have to make the decision based on what our rules and laws are. This is correctly taxed in Nevada, and I believe that the administrative law judge was incorrect in their ruling. And I'll leave that to Commissioner Littman.
Are you making a motion that I can second, or would you like me to make the motion?
I would be happy to make a motion. I would move that the administrative law judge ruling as to Utah Pacific Bridge and Steel be overturned.
I would like to second that motion.
Okay, I've got a motion and second to overturn the administrative law judge's decision with regard to Utah Pacific. I'll take a roll call vote. Commissioner Bursey.
Aye.
Commissioner Witt.
Aye.
Commissioner Littman.
Aye.
Commissioner Colesis.
Aye.
Commissioner Rigby.
Aye.
Commissioner Wren.
Aye.
Commissioner Brown.
Aye.
Okay, administrative law judge's decision is overturned. To the attorney in the Utah Pacific, Mr. Garlick, I feel like you're caught in the middle of something here that I truly apologize for. I think you did everything right in this case, and I feel for you, and we'll be rooting for you in the state of Utah forever. Okay.
Mr. Chairman, if I might,
Yes.
Will the commission issue a legal ruling or decision setting forth the legal basis for its decision, just so that we can understand that and determine whether we should appeal or not?
Yes. Mr. Soka, could you please handle that for us?
Yes, Mr. Chairman, will do.
Okay, thank you. Thank you, Mr. Garlick.
Thank you.
And Mr. Runyon, thank you. Next item, informational items, Director Young.
Thank you, Melanie, I'm Executive Director for the Department of Taxation. Moving on to agenda item number 6, informational items. Item number A on that is penalty and interest waivers granted by the department for sales and use tax, modified business tax, and excise tax, as well as item B, approval and denial of status report logs for organizations created for religious, charitable, and educational purposes. And that concludes the informational items.
Okay, there's no items for action on those. Executive Director briefing. Go ahead, Director Young.
Thank you. Again, Melanie Young, Executive Director for the Department of Taxation. The briefing today is, I want to share the past 2 months for the department has been very busy, and the coming months doesn't seem to be letting up. We did pilot credit cards in the month of September. We have not made an official announcement on that yet. We're working on a couple technical difficulties, but it is available, and taxpayers are able to pay by credit cards. We're very excited for that opportunity here in Nevada. We are working on the tax expenditure report that is due to the governor and the legislature on November 10th, as well as the annual report that's due to the governor in January. Our economist is working with the governor's finance office and legislative council bureau on revenue projections for the economic forum that will be convening in December. I'm very pleased to announce that the department will be releasing its strategic plan for fiscal years 22 and 23. This will be released on October 16th with a meeting with department leadership and an all-staff meeting on October 22nd. The strategic plan is results of efforts of the department's executive team conducting strategic planning sessions, SWOT analysis, meetings with employees, and leadership discussions. And I'd like to take a moment to recognize the executive team with the department for all their efforts on this plan. So please watch your emails and our website for the release of the strategic plan. At this time, we don't have a date for tax amnesty. We're still working on system improvements, and so that process can be automated for our taxpayers. We'll have an announcement later when we can get the system improvements completed. I'd like to share we had recently discovered an issue with modified business tax interest calculations as it pertains to extension requests. Back in 2011, there was a statutory change to NRS 360.417 that reduced the interest assessed on delinquencies from 1% to 0.75%. However, when the legislation was codified, there were 2 sections of NRS, 363A.140 and 363B.130, that were not updated, and those provisions continued to assess interest at 1%. And specifically, again, these sections pertain to the extension request of payment of modified business tax for general business, financial institutions, and mining. The statute imposes the interest at 1%, but the issue is the department incorrectly implemented the 0.75 based on the statutory change in NRS 360.417. At this time, we are working on a solution to correct this, and as statutorily, the taxpayers should be assessed the 1% interest. So going back 3 years, the data shows that we have approximately 160 taxpayers, and the interest that should have been imposed is about $45,000. The goal here is to not unduly burden the taxpayers that are affected, nor cause the large cost to the department in noticing and requiring the taxpayers to reapply for the waiver. We are currently working with our legal counsel at the AG's office on a solution, and we'll be coming to the next tax commission meeting with that. For a COVID update, we're still closed and to walk in public, but we are open by appointment only. And we have submitted a request of $327,000 in CARES funding that will be going to the October IFC. that allows for additional equipment, sanitation supplies, social distancing equipment, and PPE. Mostly the biggest part of that request would be computers to be able to allow employees who are working at home that don't have current equipment, so that we can continue the social distancing, the remote childcare issues of those parents of our employees, or our employees who are parents, who are instructing their children at home. So there's going to be a large request for some equipment to be able to accommodate that. And that concludes my briefing, and I'm available for any questions you have.
I have a question for you, Melanie. Are the credit card payments available to the marijuana operators?
That is a good question. I don't believe they are, because of the federal requirements.
It's a safety issue, I think, just handling that much cash, which is also unsanitary if you think of COVID. But for people to be coming in and out of the building with rolly bags of cash, that just gives me nightmares. It would be nice if there was a way they could maybe use a credit card company, a Canadian credit card company, or some way that they could avoid the having to use cash transactions.
Yeah, I can probably answer that from the banking side. It's still federally illegal. So nobody's going to process through your credit card processing system. It's just not going to happen. Okay, any other questions of Director Young?
I just want to thank Director Young and the staff. They are incredible. It's a pleasure to watch them orchestrate these meetings remotely, and we can only imagine what they're doing, the rest of the time. Thank you very much. I'm proud to be a Nevadan when I watch you serve this state. Thank you.
Thank you. Your words mean a lot to us here at the department.
Totally agree. Yeah, if you don't mind passing that along, I think all of us feel the same way. This is a difficult situation for every single one of us. Even though Commissioner Lippman looks a lot more relaxed than the rest of us do with the tulips behind her, I think she looks fabulous, by the way. Our next meeting is December the 7th. At this point, I'd like to invite any public comment. Is there any public comment on the telephone? Please dial *9 for any public comment.
There doesn't appear to be any public comment.
Okay, very good. Thank you, Tina. Are there any items for any future agendas that we'd like to add? Seeing none, we're adjourned. Thank you, everyone. Good meeting today. Thank you.
Thank you.
Mr. Chairman.
Thank you.